You want to pass the FTMO challenge in 2023, get funded, and even potentially quit your job? Well, that is exactly what I did 2 years ago, and I still trade that exact same funded account today, and it was the initial and sole source of my income that allowed me to quit my job just 2 years ago. In order to allow you to achieve that, we're going to start with the foundational elements that are going to be the most important when it comes to you passing the FTMO challenge, and that is starting out with general tips for passing the challenge. Second, we're going to look at my secret risk management strategy that played a massive role in allowing me to pass 4 100K FTMO challenges. We're then going to dive into a high-level overview of my entire trading strategy. Over a year ago, I made a 4-part FTMO series outlining my entire strategy, but I thought it would be valuable to make an updated version of that and compile it all into one single video. So for those of you that are newer to trading, want to know how I trade, or are looking for a new trading strategy, you're going to get all of that in this video. This is all centered around FTMO and their challenge outline, but I started my own prop firm called Lark Funding, and I think it is better than FTMO for a variety of reasons, because there is no time limit and there's only one stage that you need to pass. The link for that is down in the description below, but regardless of what company you go with, everything that I outline and teach and share with you in this video is going to help you get funded regardless of what company you go with. So grab a cup of tea, grab a cup of coffee, and let's get right into it. Let's first start off with some overall tips that are going to help you get funded, because this is going to apply to the largest number of traders. The first thing that you want to do and keep in mind when taking an FTMO challenge is that it is crucial and imperative that you do your very, very best to start your challenge with a winner. Now, I know what you're thinking. Obviously, you want it to be a winner. Who would want to have a loser? But the luxury of an FTMO challenge is that the challenge only starts when you take your very first trade, which means that you could sign up for a challenge and only take it in 3 months, which means that you need to be absolutely disciplined in determining what trade you are going to take that is going to start the challenge. Now, I don't know how you trade. You might be trading the 1-minute chart, or you might be a 5-minute warrior. I hope you are not. But for me, when I took my challenges, I focused primarily on the 4-hour and the daily setup, and I waited for the absolute best setup. For my trading strategy, as you will see later in that video, that is a daily time frame setup with a whole bunch of confluences. Regardless of how you trade, I'm sure you know what a perfect setup for you looks like. So I highly encourage you to only start your challenge when one of those setups appear. If it takes 1 month, 3 months, or 6 months for one of your perfect setups to appear, it doesn't matter. Please start your challenge, have patience, start it with one of those great setups, because it is much more likely that it will be a winner, and that win, especially when you're taking a challenge and you're a little bit nervous, is going to generate a ton of momentum and a ton of confidence for you, and things will start to get easier and easier as you build up momentum and you start to build up the account. If you start with a loser, the stress just compounds and things get difficult, and you're just trying to build yourself out of a hole. So be patient, be disciplined, and make sure that your first trade is a winner. The second thing that you want to keep in mind is your number one goal is actually not to pass the challenge. Your number one goal, like all things when it comes to investing and trading, is wealth preservation. And when it comes to an FTMO challenge, that means that you do not want to blow the deposit that you spent on the challenge. If you follow all of the trading criteria and you don't violate any of the daily or maximum drawdown rules, FTMO provides you with a free refund, a free retrial, and you don't have to pay again to sign up for a challenge. And this is fantastic because generating 10% in just 30 days is very difficult, and oftentimes you're at the whim of the market. You could be the best trader in the world, but if there aren't enough setups that appear for you, you're simply not going to make that 10%. And so your number one goal shouldn't be hitting that 10%. Your number one goal should be remaining disciplined, remaining risk managed, and ensuring that if you only make 4%, 5%, 6%, it doesn't matter, because you are going to get that free retry. When I started to focus on protecting the $700 that I put into the challenge rather than just trying to run towards the 10%, actually took a lot of stress off of me, because I knew that, heck, if I didn't have a great month and I only made 2%, but I still followed all the trading rules, I'll just try again next month and the month after that. And over time, I knew that eventually I would hit that 10% mark. The third overall tip is determining when to actually take a challenge. I get asked this question all the time. When should I take a challenge? And for me, I took a challenge when I was ending each and every week profitable. I wasn't tracking my percentage returns and ensuring that every single month I was making 10%, because I wasn't. But when I started to build momentum and I knew that each week, for the most part, I was ending it profitable and I was making money and I was seeing more green than red, I knew that I was going to be able to take a challenge. And that is because of how we will play with risk and adjust it accordingly to our needs. You don't have to be making 10%. You don't have to necessarily even be passing a whole bunch of FTMO free trials before taking the challenge. I've never once taken a free FTMO trial. And so just ensure that you're profitable, you know your strategy, you know your trading plan, you're following your rules, you're disciplined. And once you see that you're starting to build up momentum and you're becoming a consistently profitable trader, I think that is the best time for you to consider taking an FTMO challenge. Okay, I now want to talk about risk management, which is not only the most important aspect of trading, but it's also the most important aspect when it comes to taking a funding challenge. There's two things that you want to keep in mind.
Risk disclosure.
The first is that you want to start small and you want to build up momentum. In life and in trading, I am all about building momentum, about starting small, about doing the smallest possible task to get momentum, because that is what's going to push you forward. And so I think this is the best way to approach taking a challenge. If you start small rather than risking 5% and trying to pass in one day, like so many YouTubers post about, oh, I passed in 20 minutes. That's great. It's cool to flex like that, but it's not the approach that professional and risk managed traders take. Start small and build momentum and build off of each win. In terms of starting small, this brings me to my secret risk management strategy that completely transformed my trading, and I call it the 1-3-4.5 risk management system. This is how it works. You're going to risk 1% on the first 3 trades until you have 3 winners. What this is going to allow you to do is it's going to allow you to grow your account to 3%. Now, this is being very conservative because this is assuming just a minimum 1-to-1 risk to reward trade. You're going to risk 1% in order to make 1%. That means that if you have 3 consecutive winners, if you risk 1%, you will be up 3%. If you have a loser at any point along this process, you just continue to risk 1% until your account is net positive 3%. 3% is the North Star. Once you hit that, we move from the 1 to the 3, the 1-3-4.5 strategy. So at 3, what you're going to do is on your next trade, which ideally you're being patient and disciplined throughout the whole process. So ideally this trade is going to be a very strong setup. You're going to risk 3%. If you have a winning trade, if your risk to reward is just 1-to-1, you're now going to be up 6%. But many of you watching this will actually have risk to rewards much larger than 1-to-1. And so you'll likely be up much more than 6%. And it might not even take you 3 trades to get to the initial 3% mark. But again, this is being conservative. So you risk 3% in order to make a minimum of 3%. If that is a winner, your account is now going to be up 6%, which is fantastic. You're only 4% away from passing. If it is a losing trade, you are now at break even. It is at this point that I encourage you to stop trading that account because you're likely 1 or 2 weeks in and you're going to want to wait for that free retry. Trying to make 10% in just 2 trading weeks is going to be really difficult. So you're going to want to get that free retry. Let's say, however, that it is a win. You are now up 6%, which brings us to the 4.5 part of the risk management strategy. The reason you're not going to risk 6% or 5% is because FTMO has 5% daily drawdown rule. And if it's a losing trade, you're going to violate the account, even though the account will still be in the positive. What you want to do is you want to risk 4.5% to get you over the hump, to get you to that 10% mark to pass the challenge. If it's a winning trade, you'll exceed the 10% target and you will pass the challenge. If it is a losing trade, you'll still be net positive, which will allow you to get that free retry, which again, as you can see at this point, this continually brings us back to the number one goal being wealth preservation rather than just making the 10%. This risk management strategy completely transformed my trading because initially I was risking 1% and doing that to make 10% in just 30 days is ridiculous. It's so difficult, especially if you don't have crazy 1-to-5 risk to reward trades. So by doing this and leveraging the gains and the momentum that you build from each winning trade, it's going to allow you to pass that much faster. Some of my challenges I literally passed in less than 2 weeks because of this. You have a few wins, you build off of them, and then you can use that to hit that 10% target that much easier. Okay, so we're going to focus on 3 tools, 3 confluences that are going to allow us to determine when to enter a trade and why we're going to enter it. Now, all of these are going to be rather simple, but don't let the simplicity fool you. First one that we're going to start with is going to be key levels. So I pulled up a chart here on GJ on the 4 hour, and we're going to start with key levels, which is typically what I like to start with because it's going to give us a broad overview of what levels the market is currently bouncing and moving in between. So first off, we're going to just throw them on the highest highs and the most significant lows that we can find. And one tool that I like to always keep in the back of my mind is what level would your 8-year-old niece or nephew point out if you were asking them, where's the high and where's the low? You don't want to be zooming in on a low time frame to try and determine where these significant levels are. You want to keep it super simple. Now that we've defined the highs and the lows, the next step is going to be to determine additional levels. Again, asking yourself what your 8-year-old niece or nephew would point out. And it's important that we actually do this rather accurately because key levels will often play a large determining factor in terms of how we are going to set our stop loss. So I don't want to put these as green because we will be using boxes to determine our buys and our sells. So we're actually going to stick with purple. What we have here is a very obvious and very clear key level, but this should be defined more clearly. A lot of people like to think of support and resistance as an X price, and there are psychological levels that we're not going to look into in this video, but they do play a factor. But you need to remember that support and resistance is always a zone. It's not just an X price, because market is never going to just hit one price absolutely perfectly and then move. It's always going to be a zone. And so we need to make sure that we're actually identifying that in our analysis. So in order to do this, the key is in the wicks. If there is ever a secret, it's going to be in the wicks. Now, what you want to do is you want to look at the last time that price hit a level and you want to see how it reacted. So last time price hit this level was right over here. We want to identify the highest point of the wick, and we want to identify the lowest part of the wick or the candle that the market started to react to. This second half sometimes can be a little bit tricky, but it doesn't have to be 100% objective. You're just asking yourself, how low should it be in terms of the market reacting to it, because you don't want to miss the setup. If you put it all the way up here, the market could easily react right here and you would miss the trade. And so you want to make sure that you're actually being somewhat generous. And so I would bring it down to here, because this is perfectly in line with the end or the start of this wick right here. So that is how we would identify this zone. And then if you'd like personal preference, you can drag it across to see how many touches we have received. You can see that we've had a whole bunch across this line. Now, the reason why it is so important to identify the highest part of the zone is it's going to help us identify how to properly place our stop loss. If you have your zone too tight, you might put your stop loss just above it and you could get wicked out. So that is why we need to always ensure that we are properly drawing and extending the zone sufficient amount. And we will look at this more closely when we look at execution to determine how to place our stop loss properly. So now that this has been taken care of, we want to throw a few more of these on. This rule would apply to all levels. However, if it's a significant low or high, there's not necessarily a huge point in making it absolutely massive. Here, it could be worth it because we can see that the wick, we have another level or wick touch just higher up here. So that might be worth it. However, yeah, we'll just leave it like that, because again, we're never taking a trade just off of one confluence. We're going to be building up confluences, so it doesn't necessarily matter exact precision when it comes to a level like this, but I will want to keep it as purple. Again, there will be personal preferences that you can follow or adopt. Now, we have a rather large zone here of several hundred pips. I would want to identify the most major levels rather than throwing on dozens. I would start by focusing on this one right here. You can see that it turned to support and resistance. It was support here, it was resistance here, resistance all across here, and now it is acting as a level of support. So again, we want to look at the most recent clear time that the market actually reacted to this level. We want to adjust the box accordingly. So I'm looking at this level here because here there's a lot of, activity, but it's not super clear. So I would certainly want to bring it down to this wick right here, that blue candle, and I would want to ensure that it comes up all the way to this level here. And that's going to ensure that, this box is identifying the proper zone that the market could potentially react to. Next one that I see that is rather obvious and rather strong would be this one right here, which could be quite thin. You could see resistance turn to support, and we haven't retested it yet. So we'll definitely want to be keeping an eye on this area when it comes to next time the market approaches it. So we have the box including that lower wick, and we have it all the way up to the top. So that's another good zone. We wanted to throw one more on here. Could look to the left. There's certainly something just before this major support level. I'm looking at this low here as well. Again, I would combine this with psychological levels. GJ is a little bit unique in terms of how the market views psychological levels. 165 is certainly, a level that we would want to pay attention to, but it's not always precisely exactly how GJ reacts to levels. But I would definitely have it like this. You can see we have support here, and it moves across and it works quite nicely. So that is how I would identify key levels. Again, we're going to look at how we would measure the zone in terms of placing our stop loss. It's a very simple tool to implement into our trading. There's tons of resources online if you don't like listening to my voice in how I explain them or how I do them, which is a little bit unique compared to some other traders that I have seen, but it's how I like to first approach the charts when everything is completely blank, and then we'll go from there. The next tool that we want to look at is actually my favorite, and it is Fibonacci. Fibonacci, I simply could not trade without, and it is such a powerful and such an important tool that we will really dive into and really pay close attention to. It's going to massively help our trading in a variety of ways. Okay, so the first thing that is most important to figure out and to know is what levels are we actually going to use. So I'm going to throw a Fibonacci on right here, and I will show you the levels that are most important. You don't have to look at all of these. I don't even use all of these anymore. I used to. The most important, very straightforward, 38.2, 50, and 61.8. The 50 level, fun fact, isn't actually a Fibonacci level. It just represents a 50% retracement, which is a level that a ton of traders look at, including myself, including you now. So that is why we throw it on. 38.2 and 61.8 are, of course, the best levels. Now, the way to approach Fibonacci, perhaps you are completely completely new to trading and you never heard of it, I doubt that is likely the case. But if you are, quick refresher, we want to draw it from the most significant high to the most significant low if the market is in a downtrend. So in this situation, we would draw it from the high all the way down to the low, and we could see where the market has retraced to. So the 38 had a little bit of a reaction, but really it was more of the 50 that we reacted to. If we draw it down to this low, you could see that we had a beautiful bounce right off of the 61, 2 touches, and then we dropped lower. What will blow your mind, however, is that there is one little trick that you need to apply to your trading that will make a massive difference, and I don't know of really anybody else that talks about this, and it is the rule of not extending the Fibonacci level if at any point the fib broke the 61.8. The reason that this is so important because Fibonacci allows us to determine at what point during a retracement that the market is going to bounce, and if the market has broken the 61.8, it shows that the market is not trending. We're in a period of consolidation, and that means that the fib is much less likely to work. We want to make sure that the market is trending, and if the market is trending, it means that it is much more likely to bounce off of one of our levels, and therefore it will be a successful trade. So I'm going to show you a few examples of this because some traders seem to get confused, but it's really quite simple, and you need to think of Fibonacci and draw it in terms of a linear progression of time. So many traders get confused and say, oh, it broke the 61 fib, but it actually didn't, because at the time that level that you're pointing out wasn't actually the 61. So see if I can find a good example. So this is a high down to the low. We did not at any point break the 61. We didn't even touch it, so we could then extend it. At that point we did touch the 61, but we didn't break it. So this fib is entirely valid. However, we won't want to be trading it for a variety of reasons that potentially we will get into. But this is how we would draw that level. Let's say, however, that we wanted to look for a buy. We would first look for the most significant low, which of course would be this. We draw it up to the high, and what happens? We break the 61. So you would not want to be using this fib. You would need to wait for the next low, and you would need to draw it from there to determine whether it would actually be a valid level to take. For example, and this proves my case of it being a period of consolidation when we do break the 61 fib. We are just moving sideways at this. So what you could do, however, is you could look at this low and you could draw it from here. So we made a high here, we bounced up to 38, we did not break the 61, and so therefore it can be extended. We're now at the 38 level, but we have not yet hit the 50 and we have not yet hit the 61.8, which means that both of these levels are still valid. At this point, you can already start to see that the 61.8 coincides very nicely with one of the key levels that we drew right here, and potentially that could be an area for a trade that we would want to take. Now, we'll likely discuss this when it comes to execution, but I think it would be important to point out now why we don't want to use a level more than twice. Because we're going to be using a lot of pending orders, in order for a certain zone to work, there needs to be enough orders in that area to move the market. And if price has already hit a certain zone, it means that all of the orders that were in that zone have already been picked up. Now, it doesn't necessarily mean that there won't be enough orders in that zone the second or third time that the market hits that area, but it makes it much less likely because those initial orders have already been placed. And that is why we will often see each subsequent move of retesting a zone get smaller and smaller until eventually we do break it. And oftentimes we won't even get a bounce if the market hits a zone a second time. So you really want to make sure throughout your entire analysis and execution process that you are not taking a zone that has already been used. I've get a ton of traders that send me trades asking me what I think of that zone, and I'll say it was fantastic and it was a great trade if you took it last week, or if you took it 2 weeks ago. The market has already used that zone, so ensure that you're always using a fresh zone and that there's going to be enough orders to actually allow your trade to play out. So you know that the three levels that we use are the 38.2, the 50, and the 61.8. You know that we don't want to use any of the levels if it has already been used, and we cannot extend the fib level if at any point it has reached the 61.8. Those are pretty much all of the major things that you need to know. I'll do my very best to link up a video that I made roughly a year ago that potentially covers fibs a little bit more in depth than it does in this video, but for the sake of this not turning into a 3-hour marathon, it is now time to focus on the third and final confluence tool that we're going to use, which is potentially my favorite. Very simple, and it is moving averages. I first started out by using SMAs, simple moving averages, because that's essentially what everybody said you should use. But then I took a couple of courses and they were using EMAs, and I was like, exponential puts a little bit more weight on more recent price action, so maybe I should be using that. I came to learn that both of them work, and so that is why I throw on both the EMA and the SMA levels. I am however not interested in the smaller moving averages. I only want to use the most significant ones, and so as I throw them on here, I will pull up the settings, and you can see that for both the EMA and the SMAs, I am using the 100, the 200, and the 800. Please do not ask me why I use the 800, not the 700 or the 900. I have absolutely no idea why 800 is significant and why traders use it, but that is just how the story goes. And so we are using the 800 moving average. Now, fortunately, you don't actually have to do anything with these moving averages. You just have to throw them on your chart and see how they coincide with confluences that we have now established. So we've got moving averages, we have fibs, and we have key levels. Once all of these are properly plotted onto your chart, question that you have to ask yourself is, are any of these overlapping? At any point, does a key level coincide with a fib? Does a moving average coincide with a key level or a fib? Or most importantly, and hopefully, is there a zone where all three of these line up? Because if there is, that is where you want to be taking a trade. That is where you're going to have a setup that has the highest chance of working and the highest chance of making you the big bucks. As we can see here, as we pointed out a little bit earlier, right around 166.0, we do have a key level and the 61.8. As of right now, the 38, which we did get a bounce off of, coincides with the key level and the 200 SMA or EMA. That's probably the EMA. So this was certainly a nice area to take a trade. As of right now, we have the 200 SMA lining up perfectly with the 50. So this is going to be a good area to potentially take a trade. But one thing that you always have to keep in mind with moving averages is that they are moving, which means that you might have a perfect setup lined up for tomorrow or in a couple of days. But if the market consolidates and doesn't move as quickly as you would like it to, those moving averages are going to likely move away from your zone. And you're going to be down one confluence, and therefore it is not likely going to be sufficient for you to take a trade. So just make sure that when you do have a pending order set and a trade is coming close, that all of the moving averages are still lined up. So just ensure that if you do all of your charting up on Sunday or Monday like I do, and come Wednesday you have a trade trigger, or hopefully it hasn't triggered yet but is approaching, just make sure that the moving averages are still where you want them to be and that they're still acting as a confluence. Aside from that, moving averages are quite simple, so there's nothing that you really need to know. You could certainly play around with a few different numbers. I know a lot of traders use the 50 moving average. I did at one point, but I prefer to have fewer signals but each signal be stronger, and so that's why I focus on the higher and larger moving averages. One thing that you will want to keep in mind, however, is that the moving averages are placed differently across each time frame, and the higher the time frame, the more significant it is going to be. So when the market is hitting a weekly 200 moving average, even the daily 200 moving average, it's going to be very, very significant. It's going to be very difficult for the market to break on its first attempt unless there's some kind of fundamental driver. Whereas if you look on the 5-minute or 15-minute chart, we can be breaking up, down, and sideways through all different directions of the moving averages multiple times in the same day. And so the higher the time frame, the stronger it's going to be, and the better signal it is going to be for your trading. Okay, so you have now learned how to properly chart up, how to properly draw key levels, use fibs, and throw on the moving averages, and to identify a zone of confluence, and that is where we are going to take our trade. So it is now time to talk about execution, which is the most difficult and the most important aspect of trading. Any 8-year-old can do this stuff. Charting is not complicated, it is not difficult, but execution is what is going to separate you between a trader that repeatedly fails their FTMO challenge and a trader that gets funded, and not only gets funded but repeatedly pulls money out from the market. In terms of execution, the first thing that I want to really emphasize is to focus on the higher time frames. Like I have said in terms of the confluences, the higher the time frame, the stronger the signal is going to be. And so yes, the higher the time frame you go, the more disciplined and patient you need to be, because you're going to have fewer setups, but each setup is going to be that much stronger. I passed the FTMO challenge by trading primarily on the 4-hour and the daily chart, which usually provides between 1 and 3 signals a week, 1 to 3 trades a week. There are times when the market's consolidating, like we can see on GJ, which really can be frustrating and is not very conducive for a time restricted challenge. This is why you should take a Lark Funding challenge, link in the description down below. But all that to say, play around with time frames, but I urge you to please potentially swing to one side, and that is the side of higher time frames. Just avoid the 5-minute, 1-minute charts, because that is just going to get you into a whole bunch of trouble. Beyond that, using pending orders dramatically changed my trading, made me a much better trader, because I no longer had to be in front of the market to take a trade, and I could now utilize and take advantage of the market 24/5. By using pending orders, we no longer have to wait for confirmation from the market. A lot of traders say, and this was how I was when I first started trading, that you need to wait for confirmation to confirm that the market is looking at your zone. But I think this is actually faulty thinking, because if you do wait for confirmation, you're actually taking on more risk essentially, because your stop loss is going to need to be larger than if you place a pending order. So all that to say, every single trade that we're going to take with this strategy and with the system is going to be with pending orders. I'm going to show you some specific examples for how we would set pending orders. There's a few little things that you need to keep in mind. It is really going to make the difference between you actually getting into a trade and having a winning trade versus potentially missing a trade and it turning into a loss if you do manage to get into it. One thing that you want to keep in mind, however, is that you ideally want the market to approach your pending order as fast as possible. This might seem counterintuitive when price is moving really quickly against how we're going to want the market to move. We can get scared, we can get cautious, but really that is what we want, because it shows that there's a lot of volume in the market, and the faster that the market approaches our zone, the more likely it is to reverse, because it means there will be profit taking. Whereas if we're just in a zone of consolidation and nothing is actually moving, then anything can happen. But remember, the larger the move, the more likely it is that there will be profit taking, and that is why I love taking a trade in the opposite direction of the trend on a day where there has been a 2% move or more, because you know at any moment there will be profit taking before the end of the day. Okay, so let's continue to look at the example that we have built up on GJ. As we pointed out, there's an area here on the 61.8, 166.0, and the key level. Because there are two confluences, this could be a very interesting area to take a trade. You need to determine and put in your trading plan, are you going to take trades with two confluences or three confluences? The more confluences you have, the higher likelihood is that that trade is going to work, because you have X number of traders that are looking at the fib, X number of traders that are looking at the key level, X number of traders that are looking at the moving averages. So the more you have, the better. But that does not mean that a two confluence trade can't work. I personally will do two or three. I never take a trade that is only one confluence. But here we have two. So let's determine where we would actually need to get into the trade. Question that you need to always ask yourself is, what is the first confluence? That is the most important thing. And in this situation, the first confluence is not how we drew the key level. The first confluence is a 61.8. So what you want to do is you want to throw your buy order, your buy pending order, on the first confluence. Do you want to just keep it there? No, you do not, because a pending order means that price has to push through the actual area, and we're going for sniper entry here, and there is no guarantee that the market will actually push through all the way. So what you want to do is you want to then place your pending order between 2 and 5 pips above the entry, above the first confluence. So if we are perfectly lined up, let me perfectly line it up here. We are now perfectly lined up at 166. Okay, that is not what we want. We are now perfectly lined up with the 61, which is at 166.042. This is not where we want to actually go into our C-Trader or MT4 app and put the price in. We want to raise it just a few pips. So if we want to get really nitpicky here, we could use our measuring tool and we could say, oh, we want it 5 pips. We're going to raise it just there. And this is where we would set the pending. We would set it at 166.085. This is going to allow us to actually get into the trade and to ensure that if the market doesn't hit our zone but comes super close, which means that it's essentially still hitting it, we will still get into the trade. Some traders prefer to split their pending and put potentially half or 3/4 or a quarter of their pending, of their overall position, on the higher up area, and then put the remaining portion of their position on the actual first confluence to get a better risk to reward on that lower portion of the trade. That's a personal preference. You could play around with it. I'm not going to explore that too much in this video, but just know that there is a little bit of flexibility in how you design it, and personal preference does play a little bit of a factor. The next question that we want to determine is, how large should our stop loss be? This is super important. Break out your notebook, break out your pen, write this down. Your stop loss is going to be the size of your zone plus half. But depending on that calculation, there needs to be a minimum stop loss of roughly 25 pips. For me, it's 25 pips. I will not go below that. If your zone is 5 pips, you cannot have a 7.5 pip stop loss. I do not recommend that. Sure, you could do it. Your win rate is going to be pretty bad. Your risk to reward will be fantastic. Maybe in the long term you can make money, but I prefer to have a minimum 25 pip stop loss. If the calculation, however, is 20, well, it's 20 plus half, so it is 30. My stop loss would be 30. Calculate the size of your zone by taking the distance between your first and last confluence. This is a 2 confluence trade, so we will take the 61.8 pip and we will measure how many pips down it is to the end of our key level. It is 10 pips. So that means we would have a 15 pip stop loss. That is too tight, especially on GJ. So we would have a 25 pip stop loss. So we would raise this puppy all the way up to this level rate. And that is how we would set our stop loss. Potentially, depending on your risk aversion and your risk tolerance, you could tighten that up. 25 is my rule. GJ is a little bit unique in the sense that it does move a lot. So I wouldn't actually decrease it any more than 25, but you might want it to be a bit larger, 30, 35. If there's some fundamental factor that justifies your trade, you may think that this could be a good swing trade opportunity. And so you're willing to have a 50 pip stop loss because you're going to be going for several hundred pips. I am speaking quite fast, but there's a variety of different factors that, again, I won't just explore in this video that you could consider in terms of adjusting your stop loss. But this is the rough rule of how I like to approach things. Size of your zone plus half. So in this situation, it is 25 pips. You're going to do that for every single setup. The next question that you're probably wondering, how do we set our take profit? I'm glad you asked. Excellent question. We will never take a trade that does not have less than than a 1-to-1 risk reward. 1-to-1 is always what we want. Now, for all of you smart money concept ICT traders out there that like those really juicy 20-to-1 risk to reward trades, the thing you need to understand is that there's an inverse correlation between your risk to reward and your win rate. It took me a very long time to understand this. I didn't think it was true, but I guarantee you and I promise you that mathematically it is 100% true. The smaller your risk to reward, the more trades you're going to win. The smaller your risk to reward, the more trades you're going to win. The larger your risk to reward, the fewer trades you're going to win. Each trade will be a much larger winner, but it will happen much less frequently. So if your average risk to reward trade is say 20-to-1 and you win 5% of your trades, statistically you could be a profitable trader. Emotionally, I don't know a single trader that could sustain and manage a drawdown of that kind of significance, because on average you will be losing dozens and dozens of trades in a row. So I like to go for smaller risk to reward trades and have a very steady equity curve where I am winning 75, 80, 85% of all of my trades. It keeps me less emotional and I just like seeing money come in. I'm not interested in hitting a massive home run as much as I am just steadily growing the account. So all of that to say, our minimum risk to reward on this trade being 1-to-1 would be a 25 pip stop loss. Looks quite small, and that's because it is, especially on GJ. But remember, we're trying to build momentum with this account, whether it's your first trade or last trade. 1-to-1 can carry you a very long way, especially considering the win rate that this will provide you. Does this mean that on every trade you have to close the entire position once you hit 1-to-1? Absolutely not. Depending on the fundamentals, depending on the trend, depending on the time frame, depending on the strength of the setup, all very important factors, it will determine whether or not you can try and squeeze out more pips. But for those of you that are new to this strategy, what I recommend you do is that at the very beginning, you close every trade at 1-to-1. It's going to help you build up experience, momentum, understand the strategy, and then what you can do is with your trading journal, you can track what trades go on to do more pips and what trades would go on to hit break even and not give you any more pips. Likely what you will find, the higher the time frame, the stronger the setup, the more likely it is that the trade will go on to do more pips. So in this situation, 4-hour time frame, it's a pretty major 61 fib with a psychological level. It's likely that this could do more pips. So let's say you want to try and squeeze out more, that is totally fine. For future reference, what you want to do is you want to ask yourself, if you were taking the opposite direction of the trade, where would you get out? And the first answer to that is you would want to get out at the nearest resistance level, which would be around here, because you can see there's resistance and there's the 200 moving average. So you would get out right before here. After you take TP1 at 1-to-1, you move your stop loss to break even at all times. Then you can close half your position, you can extend it, you can do a variety of different things that, again, I won't go into detail with this video because it will be a 5-hour video. I'm giving you the broad nutshell and overview of the strategy, which is more than enough for you to pass. But again, you can play around with this. You can figure out what works for you when it comes to refining things. But yes, if you want to squeeze out more pips, you absolutely can do that. I'd like to look at one more example here on pound Aussie, just to give you another example for how we would approach things. Here we have the 61 fib, which is drawn from here to here, and we have both the 200 EMA and the 200 SMA that will likely line up quite nicely. So far that is two confluences. This lines up at 1.79. 1.70 is just below, so you could actually have the round number, a psychological level as well. So I'm going to throw that on at 1.79, which is right here. So we now, again, first thing we need to do is we need to determine the size of our zone and where the first confluence is. The first confluence as of right now is a 61 fib. These moving averages, however, of course, will move higher depending on how the market moves. It could go above, they could go above the 61, they could remain in line, below, time will tell. But as of right now, the 61 is the first confluence, which means that we want to throw our buy pending order right on it and then raise it a few pips. The next question is, how large is our zone? Well, we take the first confluence of the 61 fib and we lower it all the way down to the round number of 1.790, and that is 17 pips. I don't do math in public, but that is 25.5 pips. What you want to see is that going to actually be enough? How does that look? That to me looks quite tight. So we would not have a stop loss this tight. Let's say that these moving averages move up and line up perfectly with the 61, then I would be more confident on tightening up the stop loss. But as you can see, 25 based on where we have our entry is just totally unreasonable because it's right at 1.790. So we would be foolish to have it here. What we would want is we would want about 40 pips to give it some breathing room. I'll never use a stop loss above 50 pips. If that is the case, the calculation means that I need a stop loss of 50 pips. It means that the zone is simply too large and I will look to refine it to tighten it up to have a tighter stop loss. As of right now, this is how I would set it. 40 pip stop loss, pending slightly just above, and I would watch these moving averages very closely. It means that our first take profit would also be at 40 pip, but I think that we could squeeze out some more pips and aim for 1.80 as it is a significant resistance or support turn resistance if this triggers, and it is a round number psychological psychological level. So as you can see, very straightforward, very simple. This could actually be a very good trade that if it hits with those moving averages still being in line and acting as a confluence, I would 100% take this trade. I hope you found this video helpful. This is everything that I did to pass 4 FTMO challenges that allowed me to quit my job 2 years ago and trade full time. I started my own prop firm called Lark Funding, which I think is better than FTMO for a variety of reasons, such as there being no time limit and only one stage to pass, which I think is much better aligned with the actual interest traders. The link for that is in the description down below. It's important to remember as traders that we trade to make money. And so to further help you on this journey, I highly recommend you check out this video here, which is going to help you enter the 1% and keep a few important frameworks in mind when it comes to making money beyond just trading. Drop your questions in the comment section down below. I will do my very best to answer as many of them as possible. Play the long game. I will see you in the next video. And until then, peace. When I first started trading Forex, I was working minimum wage at Tommy Hilfiger and I was absolutely miserable. I spent every second of that job dreaming of the day that I would walk in, hand that 2-week notice into my boss and never work for somebody else again. And I knew that Forex was going to be my path to achieving that. But I didn't care about the Lambos or the fancy watches. All I wanted was freedom. The ability to wake up and choose exactly how I wanted to live my day and live life on my terms. The good news is that is now my life. I now get to wake up and choose exactly what I want to do that day. The bad news, however, is that it took me 5 years to get here and I spent over $10,000 on Forex courses. But things were different back then. Education wasn't as prevalent and funding companies weren't what they are today. That means that in 2023, there is an opportunity in front of all of us that if we seize will allow us to swing the pendulum in our favor and live life by our rules. But in order to do that, we need to make some money. And it's not just about having that one good week or that one good month where you have a nice payout. It's about building a system that is going to allow you to consistently pull out money from the market. So have you ever wondered why it seems so difficult to make money trading, or why it seems like month after month, year after year, you're running in circles and not achieving your goals? I did. And the answer to that question is probably not what you would initially think. You see, over the last couple of years, the process and skill set that is required to become a successful and profitable trader has completely changed. Years ago, it was all about growing and compounding your small account to hopefully get to a point where one day it would be large enough to live off of and actually make some decent money. But now success all comes down to your ability to get funded. That means that you must pass an evaluation with FTMO, Lark Funding, or any other funding company out there. In other words, instead of needing to make 1,000% on your personal account, you only need to make 10% to achieve that life-changing goal that you are dreaming of. So how exactly do we do that? How do we make the 10% that is going to change our life? Well, we first need to understand why traders go around in circles year after year and why 99% of traders fail, and it all comes down to just 3 reasons. Your trading strategy sucks. Your psychology is just brutally terrible, and you have super poor risk management. If you're watching this video, you unfortunately fall into one of these 3 categories. But if you want to make 10%, it means that in 2023, your entire focus needs to go towards solving these problems. Now, you probably don't think that your trading strategy sucks, because if you did, it wouldn't be your strategy. And most beginner traders think that the only thing that is separating them from success is their strategy. But the truth is, strategy is actually the easiest part of trading, and almost all strategies work. That is why it can be difficult to determine whether or not you should stick with your strategy or if you should go and develop a new one. It used to work for you, so why is it no longer working today? What happened is your execution. The strategy works, it's human psychology that often doesn't. So the question you need to be asking yourself is not whether or not your strategy actually works, it's whether or not your strategy is best suited for your psychology. Now, I'm not gonna pull some Freud psychology joke and say that you self-sabotage your trading because you didn't receive enough love from your mother when when you were a child, and so now you unconsciously self-sabotage yourself because you don't feel that you're worthy of making money. But most traders get into the game for the wrong reason. It's the quick buck, the Lambos, the Instagram clout, and when traders eventually realize that Forex trading is not any of those things, things go sideways. This leads to messing with their strategy, not following their trading plan, entering a buy, and when it drops, reversing the position into a sell, and then when it starts to go up, they reverse it again.
I was wrong.
But the root cause of all of these dumb mistakes is simply misguided expectations. Change the expectations and you'll change the mindset. Problem is solved. It's why I end every single video by saying play the long game. But most traders don't do this. So in desperation, they do the worst mistake of all and they go for the Hail Mary. In an attempt to grow faster, make the big bucks, and finally have their dad be proud of them, they execute terrible risk management and they throw away weeks, months, and even years of trading progress.
Risk disclosure.
Nothing has killed more personal or funded accounts than risking too much per trade.
Ah! Ah! Ah!
Going all in and betting the house only leads to terrible losses. And when the trader blows their fourth account, they start to wonder whether their strategy is actually the problem and if something on the other side of the hill is going to work better for them. This means that the trader never gives themselves an opportunity to actually allow their trading edge to play out. And so when they do jump ship and try another strategy, that, my friends, is how this vicious cycle repeats itself. And that is how traders find themselves repeating the same mistakes and being in the same cycle month after month, year after year, never achieving their goals. To break this cycle, you need to avoid these temptations. And the only way that you're going to be able to do so is by developing a certain level of mindfulness where you will become aware when you're about to break your trading plan, not follow your risk management rules, and when your psychology is not in the state that it needs to be in order to be a successful trader. I'm telling you, if you can avoid these 3 mistakes, you will get funded. It's only a matter of time. You need to allow your trading edge to play out. And that means that when things get difficult, you don't jump ship. You don't mix up what you're doing. You act and treat your trading like a casino treats its business. You allow your edge to play out. You do not focus on the next trade. You focus on the next 100 trades. But even knowing these 3 traps and the 3 most common reasons for why traders fail, trading can get scary. And for the longest time, I let fear dictate my trading. I was incredibly emotional, and that is why you need to watch this video here that is going to help you recognize more of the most common traps that traders make to help you transform your trading in 2023. Play the long game. I'll see you in the next one. Until then, peace. You want to pass the FTMO challenge and quit your job before the end of 2022. If you're watching this video, it's because you are not yet a funded trader, and it's likely that what you are currently doing is not working. So we're here to fix that. In this video, I'm going to give you my 5-part FTMO framework that allowed me to use FTMO to quit my job 18 months ago. Let's get into it. First step is consistency and growth before taking a challenge. Tons of traders take a challenge long before they're consistent and long before they're ready, and therefore they're just throwing their hard-earned money away because it is very, very unlikely that they're going to pass. Why set yourself up for failure from the very beginning? I understand that FTMO funded accounts are very elusive and very attractive, but in these early stages, you can't focus on these accounts and you need to focus on supercharging your growth and building up that consistency. One approach to accomplishing this is to take a ton of FTMO free trials so you can test out your strategy and your system in relation to the challenge. Are you able to actually generate that 10% in 30 days? And do you have the tools to pass the challenge? I personally did not do this before taking any of my FTMO challenges. The approach that I took was just to trade my personal live account and to track my results. What I wanted to see was that I was ending each week profitable. I knew that if I was consistently profitable at the end of each week, that I was going to be able to adjust my risk strategy accordingly and pass the challenge. In order to build up this consistency, if you're in the very early stages, I encourage you to go through Baby Pips. It's a phenomenal free course, but because you already know about FTMO, there's a good chance that you are now beyond this stage, and it's now a matter of continuing to refine and define your trading edge. By doing this and continuing to work on your fundamentals over time and with a little bit of patience, you'll then be ready to take a challenge. But the question is, what challenge do you actually take? Selecting the right funding company can be the difference between passing and failing the challenge. Now, 18 months ago, when I took my first FTMO challenge, this wasn't nearly as important of a debate as it is today. The main division today is between taking a time-based challenge and a non-time-based challenge. Because this is such an important debate and it can be the difference between passing and failing, let's break down some of the pros and cons for both companies so you can determine which one is going to give you the highest chance of passing. When it comes to time-based challenges, many traders focus on the fact that there is higher drawdown limits. With FTMO, for example, you can have a maximum daily drawdown of 5% and a maximum overall drawdown of 10%. Now, this is a ton of breathing room, but when you actually think about it, is that breathing room necessary? That breathing room is a result of the company essentially forcing you to not remain risk managed. Because you only have 30 days to pass that initial phase, risking 0.5% or 1% throughout the entire challenge very likely is not going to get you to that 10% mark. And so to compensate for that, companies need to increase that maximum drawdown limit, but you can avoid this altogether by just simply not taking a time restricted challenge. All of that to say, don't let the higher drawdown limits fool you into thinking that it's going to be easier to pass. Another pro that a lot of traders tend to focus on and gravitate towards is the higher leverage. I've come to learn since starting this channel that a lot of traders don't actually understand leverage and how it works. So many of these companies like FTMO offer 1 to 100 leverage, which is a ton, but the reality is if you are remaining risk managed, you will never ever need to actually use this leverage to its full capacity. And if you are using it to its full capacity, you are doing something wrong. The only time this should ever happen, and there's still a caveat to that ever, is if you are a scalper and opening a ton of positions at once. Even in that situation, if you are using it to its full capacity, you're simply overexposed to the market, and one volatile swing will totally wipe out your account. So don't let these really flashy and really large leverage sizes from 1 to 100 or 1 to 200 think that it's going to allow you to pass faster, because it is simply not. I've come to realize that leverage is kind of an addiction. Traders think that without it, they're not going to be able to actually make a lot of money, and it is simply not the case. So I highly encourage you to assess and thoroughly think out what leverage means in your trading and how much leverage you actually need. With these time restrictions, however, it is likely that you will be able to get funded faster than if you take a non-time restricted challenge. This is because FTMO forces you to pass the first stage within 30 days and the second stage within 60 days. And other competitors are right around the exact same time limits. Because of this restriction, it's very black and white. You know that within 90 days, whether or not you will be funded. You know within 30 days, whether or not you will pass that first stage, which is the most difficult. Now, obviously, it's nice to know as soon as possible whether or not you're going to pass, but these reasons in and of themselves is not a reason to go with a time restricted challenge. I went with FTMO 18 months ago because they were the #1 in the industry, and they continue to remain so. But the option of taking a challenge that was not based on a time restriction simply did not exist. I believe that the funding space is slowly moving towards these challenges that aren't going to be based on time, because they no longer force you to be at the whim of the market. You can be the best trader in the world, but if the market doesn't provide you with enough setups that fit your trading plan, or if we're just in a period of consolidation like we've seen over the last several months, no matter how great of a trader you are, you're simply not going to be able to pass, and to me, that just doesn't seem fair. By having no time restriction, you're actually able to remain risk managed, which I think is a massive pro, because companies that are forcing you to pass within 30 days, I don't think they have the trader's best benefit in mind, because they're forcing you to take on higher risk to pass within that constrained time period. One of the drawdowns with non-time restricted challenges, however, is that there are tighter drawdown limits. Many companies offer 4% daily drawdown to maximum 5% overall drawdowns, which for some traders, they will need to adjust their trading accordingly. But if you're seeing more than a 4% swing in a single day, you have other problems than figuring out what funding company to go with. So the question is, what do you prioritize? Ask yourself, if you were to design a funding challenge yourself, what would the criteria and outline be? Now, of course, we all want a non-time restricted challenge where there's only a 1% profit target in order to get funded, but be realistic. Ask yourself what would be the most ideal for your trading, and then find the company that best suits your trading style. Do you really need that higher leverage? Do you want your success or failure to depend on the market conditions? Personally, I do not, which is why I started Lark Funding. Slight plug there, link is in the description down below. It is at this point that it is now time to take the challenge, and you want to best prepare yourself to pass and not forfeit and lose the money that you spent on the challenge. Let's talk about two frameworks that helped me get funded with $400,000. The first framework is what I call the 3-3-4.5 risk strategy. The downside of time restricted challenges is that you are forced to not remain risk managed. But if we go with an FTMO challenge, we just have to bite the bullet and adapt accordingly. And that is what this strategy does. The first three in the 3-3-4.5 is the first 3 trades that you need to take, risking 1% per trade. 1% is the sweet spot because you need to start building up momentum. Anything above 1% when you're first starting off the challenge is too much, because just a couple of losses you could be down to 4 or 5% or more. About building up that momentum. My number one priority is never actually passing. That's my secondary priority. My first priority is always protecting the capital that I invested in taking the challenge. Worst case scenario, we always want to receive that free retry. So for the first 3 trades, you're going to risk 1%. Once you are up 3%, so if you have 3 consecutive wins in a row, or however long it takes you, once you are up 3%, we're going to increase the risk on your next trade to 3%. We're going to do this because if that trade is a loss, you're going to be back down to break even, and you can then wait to receive that free retry, or you can continue risking 1% depending on how much time is left. However, we need to start stepping on the gas a little bit because those days remaining are starting to count down. You're gonna risk 3% in order to make a minimum of 3% depending on what your risk to reward is. At the bare minimum, if this is a winning trade, you are now going to be up 6%. It's at this point that you're only 1 winning trade away from passing the FTMO challenge. Lastly, you're going to risk 4.5% in order to get you over that edge and hit that 10% target. By using this risk strategy, you can pass the FTMO challenge in as little as 5 trades. The second framework that I use during my challenges and I continue to use in my trading is the input versus output framework. During an FTMO challenge, there are a variety of reasons why we are stressed. For starters, we want to pass, and secondly, we don't want to lose the money that we invested into that account. And in order to reduce that stress, we need to focus on our inputs rather than the outputs. The harsh reality is that achieving a 10% target within 30 days is 100% outside of your control. You can't control how many setups fit your trading plan. You can't control how the market moves within those 30 days. It's therefore imperative that you focus what is within your control, because that's going to make you a more efficient, a more effective trader, and it's actually going to allow you to hit goals that are within your control. A few variables that are within our control is our risk management strategy, our trading plan, how much work we put into our trading. For example, are you going to say from 8 to 12 o'clock, I'm going to be at the chart trading, watching the news, analyzing my potential setup, and your emotions and psychology are also within your control. Take these 4 variables and brainstorm some goals that are within your control, and you're gonna find that your trading becomes much less stressful and you're gonna become a better trader because of it. It's at this point that you have now passed the FTMO challenge or any other challenge that you have pursued, and you are now a funded trader. Congratulations. It is at this point that you are likely very eager to hand in that 2-week notice and quit your job, but I encourage you to not move quite so quickly. Quitting your job right off the bat might not actually be the best approach, because obviously our goal with trading is to make as much money as possible. The first step after passing is actually to reassess our goals. Is trading full-time something that we want to actually pursue, or potentially do we want to use our funded account as a really solid source of secondary income? The latter is actually much less stressful, and I think it is very underrated. Like the market, payouts in this game are very inconsistent. By quitting your job and having 100% of your income rely on your trading results, it can be a very stressful environment to put yourself in, and it often leads to negative trading results due to the stress. What about those traders that do want to go full-time? I totally understand. My goal from day one since I started trading Forex was always to make enough money so I could quit my job. So if that is your goal, here are a few things you need to keep in mind. For starters, you need to have at least 6 months of expenses saved up. If you only have 1 month worth of expenses saved up and you're thinking about quitting your job, I really don't think that is the best approach. The stress that you're going to put on yourself is going to be unreasonable. So a bare minimum of 6 months going to allow you to have a pretty nice cushion and a pretty nice buffer to allow you to have a few months where you might not receive a payout. The more months of savings you have, the better, but I think the bare minimum cost of entry is 6 months. Secondly, you want to make the cost of entry as low as possible. What I mean by this is you don't want to focus and rely on percentage returns every month. You want to focus on building up your capital and building up your funding, because it's going to provide you with the ability to make incredibly low monthly returns and yet still pay your bills. If you only need to generate 1% a month on your funded account in order to sustain yourself and have a decent living, that is phenomenal. I think anybody watching this video can comfortably say that they could generate a 1% return every single month. But if you need to generate 5% or 10% every month, I think you're setting yourself up for failure, and it's going to be an unreasonable expectation of yourself long term. And the stress that's going to come with that is just going to not be worth it. Thirdly, you need to build a second source of income if you are going to trade full time. 100% relying on your trading income is again going to force you to take trades and setups that you otherwise wouldn't if you do have a bill payment coming up and you haven't made money for that month. So if you're still in a job, I encourage you to start pursuing that side income, that hobby, that project you've been putting off to the side. Try and build some momentum with that, because that's going to allow you to take the leap into full-time trading that much easier if you know that you have an extra $500 or an extra $1,000 that you can fall back on every month if you aren't actually receiving a payout from your funded account that month. It's important to remember that there's a reason that less than 10% of funded traders consistently receive payouts from their funded accounts. Many traders think that upon passing and receiving their live account that they are home free and that the hard work is over. But the reality is, really, your work is only just beginning. Step 5, continue to grow. Once you're funded, you have proven to yourself and others that you know how to trade. So continue reinvesting those trading profits into more challenges so you can build up that capital base. This makes things way less stressful, and again, if you only need to generate 1% a month to pay your bills, you're gonna be laughing all the way to the bank. Where I see many traders go wrong is treating their live funded account like a challenge account. You've had the mindset that you need to generate 10% in 30 days, but that is no longer the case, and you need to make that proper transition of mindset and approach when it comes to your funded account. Don't risk 1% every trade, because you're going to be playing with fire. I think the sweet spot for funded accounts is risking 0.5% per trade. If you build up that capital, there's nothing wrong with increasing your risk over time. You can continue to use the 3-3-4.5 risk strategy if you'd like, but for me, I continue to risk 0.5% on my funded account, and it reduces the stress. It allows me to take a lot of setups and not worry about the outcome, and it just makes my trading overall much easier. So the only question remaining is, what's stopping you from getting funded? Thank you for watching this video. Check out this video here where I tried Signal services for a week. I'll see you in the next one, and until then, peace.
Both here celebrating our $10 million ring.
Most universities in the United States have studied my YouTube video.
$10,000 Rolex, $100,000 on the table, $100 million.
Frankly, I don't give a fuck. I really do not give a fuck.
Yup, $10,000, it is a lot of money. And you would think that after spending that much money on courses, you'd be able to break down and dissect the market like a surgeon. But you'd be wrong. If anything, I was maybe even more confused after taking all of these courses. Sure, some of my questions had been answered, I knew what a freaking pip was, but I still had a lot of doubt and uncertainty regarding my strategy, how well it was gonna work, whether I could actually make money from trading, and of course how long it would take me to actually become a profitable trader. So in today's video, I want to talk about what I've learned from all of these courses, and just a warning, it's probably going to be an unpopular opinion, but consider yourselves warned. With all that being said, let's get right into it. After spending $10,000 on Forex courses, I have come to learn that there is no strategy or system that you cannot find on baby pips for free. Now, I already hear all the Forex Lambo gurus yelling and saying that that is not true.
You do not understand. I can't lie.
But I have a mentorship program. It is a paid program, and I tell everybody that signs up or asks that you can find everything that I teach for free online. And I think that that is why maybe the Forex community has such a kind of sketchy, almost slimy reputation to it. So much marketing or advertising revolves around pretending like you've got some kind of secret. But trust me, I've taken a lot of courses, I've spent a lot of money, and there is no secret. There is no information that somebody is telling you that you cannot find for free online. So if anybody is trying to tell you otherwise, please don't believe them. They really just want your money. They really want you to believe that trading is so difficult that no matter what you do, you will not be able to succeed without them. And that's simply just is not the case. So the question is, what's the point of even taking Forex courses? Forex courses allow you to learn a lot faster than you most likely would learn trying to figure things out on your own. And secondly, each course has a different method of delivering the information that is going to allow you to learn. So that's an important point. Everybody explains things in their own different and unique way. This is the exact reason why you might watch my channel over somebody else's or somebody else's over mine. It really all just comes down to the delivery method of information. What one person likes Indian food, the other person likes Mexican food. That doesn't mean one is better than the other. They're just different, and everybody has their own styles and tastes and preferences. Baby Pips isn't for everyone. It's free, which is great, but some people need a little bit more structure. Some people take it more seriously if they've actually put money into a program. It holds them reliable, and some people just don't really catch on. Some people just don't really catch on to Baby Pips and how the information is delivered. And that's totally okay. There's nothing wrong with that. Like I said, everybody is different. But for those of you wondering what my learning process looked like, I've taken many courses that all were taken after I completed the full education program on Baby Pips. I started off with a company called Atlas Forex. I don't even know if they're still around. I checked out their Instagram and they haven't posted in a couple of years, so most likely not. And if you check them out, I was obviously grabbed by their screenshots of being up multi-million dollars on a single trade. So yeah, good chance they probably weren't even legit. But I paid $1,000 for their course and then $100 every single month to be part of their Telegram chat. And I did learn a few things, especially since I was just starting off and I was totally new to trading. So it wasn't a total waste, but it just didn't fully click for me. It wasn't the best. Now, not too long after I took that course, I eventually invested in the ridiculously overpriced Apex Paragon course that was almost $6,000. Now, some of you watching took that course online when it was 2 days for about $3,000. I took it when it was still being offered in person, Friday, Saturday, Sunday. It was $5,000 plus tax, so pretty pricey. Looking back, it's a ridiculous price. It's just way too much money, but I'm glad that I took it because one, I did learn a lot, and two, if I hadn't taken it in the back of my mind, I would still be thinking that possibly I'm missing some kind of tool or some kind of secret. And now I'm telling you there is no secret, but that just really goes to show how good the marketing was and how good marketing is for many of these Forex courses. When you start to think that you can't succeed without it, well, they've got you red-handed. They've got you right where they want you. About a year or two after taking the Apex Paragon course, I was starting to get a little bit of momentum, but I again got kind of stuck into another program, another course, which was the 50 cal course from the FX Cartel guys. Again, really good marketing. You see him post a lot of winning trades. And so I invested in that course, which is about 500 pounds. So it came out to almost 800 Canadian dollars, roughly around there. And it's an online course. They send you a little USB, so I did that on my own time. It didn't take that long, and that is the last course that I have spent money on. And really, it's about 95% the same thing as the Apex Paragon course. So I didn't learn a ton of new information, but there was just some minor differences between the two that I thought were interesting, and so it was definitely worth the investment. Now, beyond these courses, I have also been part of several Telegram signal chart analysis programs that are usually a monthly fee. They can be anywhere from $50 to $150 a month. Most of them are around the $100 mark, and I have been part of a bunch of those, some for only a month, some for a significant amount of time. So really, all of these put together, the sum of my overall investment is about $10,000.
Where is it?
Where's the rest?
Now, while I'd love to have the $10,000 back, I don't regret spending any of this money. People that are cheap like me tend to have a hard time spending money when it's an investment in themselves, whether that's a course or program or whatever. And yet I have no problem putting thousands of dollars into stocks, and I don't even think twice. But really this represents a disconnect, and it's a significant disconnect that I think is worth mentioning. If you're looking to make the greatest possible return on your investment, investing in stocks is betting on somebody else rather than investing in yourself or betting on yourself. To pay just $1,000 on a Forex course, it really isn't unrealistic to make that money back and then some. It's actually never been easier with funding companies like FTMO. Whereas if you were to invest $1,000 in a company, $1,000 into a stock, well, to generate a 100% return, that could take many years. And that's only if you're lucky. That stock could actually lose you money. So the potential return on your investment is far higher, in my opinion, when you're investing in yourself and betting on yourself. Obviously, if you're starting a business that is $500,000, there's a much larger risk. But ultimately, most of these courses are within the means of most people to invest in. And so if you work hard at it and you get funded, you know, you can very easily make back that investment cost and then some. So just keep that in mind. I think it was worth mentioning because anytime I want to invest in improving my skills by taking a course or program, whether that's Forex related or not, I always have this kind of restriction in the back of my mind, and it makes no sense whatsoever. We should spend money to improve ourselves, you know, otherwise what do you have money for? Like, it's much better to buy a program than just going in at like a club on a Friday night. So just keep that in mind. All of that to say, no Forex course will teach you anything that you cannot find online for free, whether that's on Baby Pips or anywhere else online. Courses, however, can speed up your learning process and deliver the information in such a way that best fits your learning style. Just don't let anybody convince you that they've got a secret strategy, system, or indicator that will make you rich and that no matter what, you will not be able to succeed without them, because that is simply not the case. And really, if you think that your learning is going to be done once you finish that course or program, really your learning is only just getting started. I continue to learn brand new things every week and make minor adjustments to my strategy every month. And I think that's why they say that learning is really a lifelong journey. So don't think that one course is going to teach you everything that you need to know, because it's a constant evolving journey, industry, whatever you want to call it. Forex is crazy, stocks are crazy, and things are always changing. So just keep that in mind. Don't let any really good marketers fool you. You can figure things out on your own. Courses can still have their place. They're still great, but keep all of those things in mind. All that to say, if you guys are still here, you have my gratitude. I'd love to hear from you, especially after a video like this, what you think about courses. Are you a firm believer in them? Do you think you're better off learning by yourself? I always like hearing from you guys. All that to say, if you're still here, you have my gratitude. I'll see you in the next video, and until then, peace. It's estimated that only 4% of Forex traders successfully pass Forex prop firm challenges, with only 1% of traders holding onto their funded accounts for the long term by not violating any rules. There are many people, probably the majority, who take the challenges again and again. I've read people who have taken over 30 challenges. So I think the statistics are skewed by a large portion of traders who take so many challenges unsuccessfully. I first started trading when I was 17, when I was sitting in class and one of my friends pulled up his laptop and started looking at the charts. I asked him what he was doing. He said he was trading Forex and that he turned $1,000 into $10,000. And I did not believe him for a single second until he actually showed me his MT4 account where there was in fact $10,000, which back then to me was an unbelievable, life-changing amount of money. My trading journey began immediately after that. I got absolutely obsessed with trading, and it did not take me long at all to realize that 90% of traders fail miserably, and that's because I was concretely in that 90% category. I lost thousands of dollars from the very beginning. I went around in circles in frustration for many years, and I even spent over $10,000 on Forex courses before I finally was able to figure out what the heck I was doing wrong. And now owning and running Lark Funding, I can actually actually see firsthand that 90% failure statistic is 100% accurate. But why? Why is something so simple as just pressing buy or sell on your MT4 account so difficult? And why do so many traders fail when it can actually be such a simple thing? I spent a lot of time going back and thinking about what it was that I was doing over those 5 years where I wasn't only not making any money, but I was losing a ton of money. And what is it that I did differently over 2 years ago when I passed my first FTMO challenge that got me $100,000 in funding? And after thinking about it, I think there's actually 3 things that not only I was doing, but pretty much every single trader that isn't where they want to be does on a consistent basis. And the worst part is they're actually not that difficult to solve. And so in this video, we're gonna go over the 3 reasons why 90% of traders fail and never get funded, and exercises that you can specifically do to get you out of that 90% category and into the 10% group. You see, when you're used to trading a $500 or $1,000 account where you only lose $10 every single trade, when you jump up to trading a $100,000 account where you can win or lose hundreds, if not thousands of dollars within seconds, it takes a massive adjustment. See, when I first started trading these accounts, I would enter a trade, and I'm gonna be honest with you, as soon as I would enter the trade, I would immediately need to run to the bathroom because of the stress. I really think most traders fail their challenges and evaluations simply because they are not prepared emotionally or psychologically to handle these larger account sizes and the larger swings that come with them. There's also a few things that traders do to exacerbate the problems. 1, not having a trading plan. 2, risking way too much. And 3, not journaling their progress so they can not only learn from their losses, but so that they can also learn from their wins and figure out what actually went well so they can do it over and over again. It's all of these things that contribute and build a weak mindset that are only going to get you into trouble. So I'm going to teach you the exact framework that I used and a very specific exercise that helped me completely get out of this rut. You see, all of us get into trading simply because we want to make money, and we don't want to make a little bit, we want to make a ton of money. As soon as I got that $100,000 account, I was online looking at AP watches, the Rolexes, the Lambos. I thought I had completely made it because I was only seeing the dollar signs. But it's that exact thing, looking at only the dollars, that's going to get you into trouble. See, the problem is just thinking about the dollars, and since we're not used to trading those larger accounts, well, heck, winning or losing $500, it's a crazy amount of money for most of us, and that is the exact problem. You see, we're thinking in terms of money, and we're not thinking in terms of percentages. You see, the beautiful thing about thinking in terms of percentages is that we can scale and grow our capital doing the exact same thing and not needing to make a single change. Making 1% on a $500 account is the exact same skill set and routine and execution as it takes to make 1% on a $500,000 account. Just the money is going to be massively different, but it doesn't matter because the percentage is the exact same. And this is where the difficulty comes in, because we are trading to make money and there's nothing wrong with that. So how can we get away from thinking about things in terms of dollars and making that shift towards percentages? Because it is a massive game changer, and for me especially, it helped so much with reducing the stress and the anxiety when it came to trading. So there's a very specific exercise that I recommend you do because it worked for me, so it might work for you. If it doesn't, that's totally fine. But here's an exercise that helped me a lot. When taking a funding challenge, it's super important that we only take the challenge once we have a solid trading plan. That might seem obvious, and it will also sound obvious that a solid trading plan will have a system in place for how we will set our take profit levels and how we will set our stop loss levels. Now with this exercise, what we want to get to is a point where we can set those exact levels and walk away and let the market hit either of them, whether it's your stop loss or your take profit. You set them for a reason, so there's no point in monitoring them or messing with those levels. You follow your trading plan, you set them, and you forget them. Now this is easier said than done. This is all about building the habit of not playing with your trades, and in not playing with them, it's easier to think in terms of percentages. And what has helped me the most accomplish and build this habit is to just reduce the amount that I am risking per per trade. If you're used to risking $500, well, risk half of that, risk $250, and see how you feel. Are you able to walk away from that trade? Because if I set up a trade where my stop loss equals a $1 loss, I'm going to forget about that trade. It's just a buck. Who cares? So you need to find that point where you can now walk away from that trade after setting that stop loss. So play around with those lot sizes and just see how you feel. Once you know what that sweet spot is, we want to work over time to build that up, to increase it over time, to then get to the level of risk that you want to actually be risking on every single trade, whether that's 0.5%, 1%, whatever it is. That's what we're building up to. So once you get to that point, you can set it, walk away, and now you are thinking in terms of percentages rather than just fixed dollar amounts that are going to mess with your psychology. This mindset, habit, and exercise has been a massive game changer in my trading journey, so definitely try that one out. Okay, so there is currently a gold rush going on in the Forex market right now with funding challenges. Everybody wants to be a funded trader, and it's those large account sizes that lead all of us to dreaming of the Lambo, the Rolex, buying that house, taking that vacation, doing that thing for your family that you've always wanted to do. And it's all of these distractions that stop 90% of us from actually doing the hard work that is required to get to that point of success. It took me 5 years before I made a single dollar from trading because I had to learn all of the hard lessons, well, the hard way, finding a strategy that best fits my psychology, burning out all of the bad habits I had, learning proper risk management. All of these things take time. Now, it doesn't mean that you also are going to need 5 years to get to the point that I got to. Heck, you could do it in a few months, you could do it in a year. Everybody is different, but all of these steps are important steps to build the foundation that we need as traders. We need to go through some hardship and learn what works and what doesn't work so that we can actually prepare ourselves to pass a funding challenge. The lesson here is don't skip the hard work, because it's actually the hard work that is going to be the key to your success. One of the things that has actually helped me a ton in this regard is setting proper goals. Rather than setting the result as the goal, I like to set the action as the goal. This has helped so much in not just trading, but in life as a whole. Sure, I would love to have 1 million subscribers on this channel, but it is completely outside of my control whether somebody watching clicks subscribe or watches my video. So rather than setting that as a goal, I set the action that I know will help me get there as the goal. For example, I set the goal of posting at least 1 video a week. And if I improve a little bit with each and every video, I know that I am setting a goal that is going to move me in the direction of that goal. And I did the exact same thing with trading. Rather than having the goal of I want to make 2% a week, I want to make 6% a month, or whatever it is, all of those goals are outside of your control because you don't know what the market's going to do. You don't know how many setups you're going to get and how the market will react to that setup. So rather than setting those goals that you can fail and it might not even be your fault, set a goal that is actually within your means. So what I set as my goal was, I said, I want to take every single trade that the market presents to me that perfectly fits my trading plan. If it fits these criteria, the criteria that I outlined in my trading plan, I'm going to execute that trade perfectly, following all of my rules. Because I know that if I do that, I'm going to hit my result goals over time. By setting the proper goals, by setting the goals that are reliant on the action rather than the result, it has helped me tremendously focus and implement the hard work that I know is required to be a successful trader. I used to be a competitive golfer. Every day in the summer, my dad would drop me off at the golf course at 7 a.m. He would pick me up at 7 p.m. And the entire day, I just did everything I could to get better. And something my golf coach used to always say was that in golf, there are a lot of things you can do to set yourself up for success before you even hit the golf ball. It's a great lesson, and I think it applies very, very well to trading. You see, in golf, you have your entire stance, your grip, how you position yourself in front of the ball, your club selection, the type of shot you're going to hit. These are all things that will set you up for success or failure before you even swing the club and hit the ball. And in trading, there's so many things you can do before you hit buy or sell in your MT4 or MT5 platform. A few of those things off the bat to consider is, what time frame are you trading? If you're a 1 minute warrior, is that setting yourself up for more success than if you were focused on the 15 15-minute chart or the 1 hour? What pairs are you focusing on? Are you focusing on too little, or do you have too many pairs in your watch list and it's just messing you up? Third, how much are you risking per trade? Sure, risking 5% a trade definitely gets the heart rate going, but it's not going to set yourself up for long-term success. And when it comes to taking and passing an evaluation and challenge, are you taking a challenge that is best suited for your trading style and your psychology? There's now a ton of funding options in the space, way more than there were just 2 years ago, and now a large portion of your success or failure can actually be determined in the type of challenge that you take. For example, if you're a scalper, you're going to need higher leverage because your stop losses are going to be quite small. If you're a swing trader, on the other hand, you're going to need the ability to hold trades over the weekend. And let's say you have a 9 to 5 where you can't stare at the charts all day. Well, you're probably going to want to take an evaluation that doesn't have a time limit because you can't take trading as your full-time job, at least not yet. The list can go on, but it's at this point that I think it's important to just take a deep breath, take a few steps back and ask yourself, what is it in an evaluation that is going to help me have the highest chance of success? I personally was tired of taking challenges that had a 30-day time limit because I didn't think that that was a fair evaluation of my skills. And then once I made that 10%, I didn't think it was fair to then force me to make another 5%. So that's why I started Lark Funding. It's a one-stage, no time limit evaluations, and we have accounts up to $1 million. For traders that are looking for higher leverage, we are also working currently on a 2-stage evaluation model that will not have a time limit, unlike most competitors. That is the plug for this video. The link for that is in the description down below. No matter how we cut it, trading is never going to be easy, and it shouldn't be. Having the ability to work from anywhere in the world, having no cap on the amount of money that you can make, it should be difficult to achieve such a luxury. 90% of traders failing and never getting funded and never making money through trading is the result of traders not putting in the hard work. If you want to enter the 1%, just do on a consistent basis what the 1% do. Thank you for watching. Check out this video here on the reality of trading funded accounts after you pass your evaluation. I will see you in the next one. Play the long game. Thanks for watching. Peace. Hi, welcome to the video. This is me currently sleeping. If you've ever wondered what I look like while I sleep, that's pretty creepy, but here it is nonetheless. So I usually wake up around 7:30 a.m., usually without an alarm, but today we're waking up at the ass crack of dawn at 6 a.m. because we've got a very important meeting before the CPI data out at 8:30 this morning. What's the meeting, you ask? Well, if you're not new to this channel, you know I make a lot of jokes about the Lambo gurus and everyone flexing with their cars. I hate to say it, but I'm becoming one of them. Yep, that's right guys, I hate to say it, but I've sold out. We're going to the Lambo dealership.
Are you kidding me?
Up and at it bright and early, and it's been a long time coming. Now, I make a lot of fun of, all the Lambo gurus and all that, but really it's just because I thought, I might not actually be able to get there myself. But now that I'm trading 400K with the profit splits, even only a few percent a month, it's going to allow me to kind of fulfill one of my long-term, long-held dreams. So I'm pretty pumped, and I'm pretty pumped I'm going to get to bring you guys with me, because it really goes to show what's possible in Forex trading. And just as a side note, for those of you that aren't new to the channel, have been following me for a little while, you probably remember what I received for Christmas. For those of you that want an update, just know that the toilet paper collection is still going strong. Okay, with all that being said, let's hit the road. So as you might be able to tell based on my attire, I'm not actually going to the Lambo dealership.
Are you kidding me?
Going to the gym. Now, I don't splurge on a lot of things. Many of you know that I'm really quite cheap, but the gym is something that I splurge quite a bit on. See, many people don't have problems spending hundreds of dollars going out to eat, drinks, all that kind of stuff. I don't do any of that. So you can't really put a price on your health either. I go to a gym
that has a sauna. There's no other gym close to me that has a sauna. Big sauna guy, big sauna fan, love it. It relates really well to kind of 3 lessons that I want to talk about in this video of being a full-time trader, trading, you know, several $100,000, and that is the importance of having a routine, having a schedule, because trading is incredibly boring. Good trading is especially boring, and so having that routine, going to the gym every morning, I like going in the morning, really helps get my day started. And I mean, at 6 a.m. there's nobody in the gym. Who doesn't love having an empty gym all to yourself? Just feel better about yourself working out in the morning. Good way to start the day. Can't complain. Speaking of cars though, I did just make a small minor purchase. Little BMW. Just kidding. Unpopular opinion. Really don't like BMWs. Trading full-time, 400K, 100K, trading as a significant piece of your side income, there's a few things that you need to know that aren't really shared anywhere else, because there's a lot of unrealistic expectations when it comes to trading Forex, full-time, part-time, whatever it is. It's the importance of having a routine and a schedule. Because it's boring, you really need to force yourself to get on a routine, get on a schedule. I think the most important thing that I can share with you is how realistic is full-time trading. Is it a realistic goal, part-time trading, whatever it is? How realistic is it for the average trader to achieve? Because we all want the Lambos, we all want the stacks of money, but I've been trading full-time for 2 years now. Still no Lambo, and not really any stacks. Okay. So the question is, can anyone become a full-time trader? I think the answer to that question is yes, but not necessarily in the way that many people expect. I was a full-time trader for about 9 months before I started this YouTube channel. I had no other source of income other than trading profits from my FTMO account, and I have to say, if I had an extravagant lifestyle with a lot of expenses, I probably wouldn't have felt comfortable to take the plunge, quit my job, and go full time. I would have been super stressed, even more stressed than I was at the beginning, and I think that's what's going to stop a lot of traders. Many people in life, whether traders or just regular people that don't trade at all, I personally think spend way too much money on frivolous things. I'd like to think of myself as kind of a minimalist. I am pretty cheap, maybe to a fault, but that allows me to save a whole bunch of money and to do things with that money that other people might not be able to do. For example, if an opportunity comes up, I might be able to say yes to that opportunity just because I have savings, whereas other people that go out, spend a lot of money, and don't have those savings, they might not be able to say yes. And this relates really well to your ability or inability to trade full-time. If you're spending tons of money on things that are unnecessary, you're going to need to make a lot more money from trading, and that is obviously going to be more difficult, and it's going to be more difficult for you to actually go full-time. So my recommendation for those of you watching that aren't full-time traders, or really have it as one of your lofty goals, I encourage you now to seriously look at where you're spending money and try and cut back. What is the minimum amount of money that you need to live on full-time? For me, it was about bare minimum, it was $1,000, which really isn't that much money. At the time, it covered my rent, it covered my expenses. Now I do need a little bit more, but starting out, it was $1,000. I wouldn't have had any savings, anything left over to put on the side, but that would have paid my bills. And that low threshold allowed me to quit my job and just do my very best to try and take it full time. One of the biggest issues I see with traders when it comes to wanting to go full time full-time is that they have unrealistic and unmanaged expectations. If you're not realistic about things in terms of how much money you can make, how long it's going to take you to make that kind of money, then you're not going to be patient. You're going to either mess up your trading, not follow your trading plan, or when things get difficult, you're not going to stick with it long enough. All of this will lead to frustration, that will lead to you not following proper risk management, and you'll continue to be clocking in to that 9 to 5 Monday to Friday, and you just won't hit that goal. So ultimately, it does come down to patience and hard work and just sticking with it. I traded for 4 years before I really started to see any kind of significant payout, both just personally and financially. Which brings us to the last point, and that is that the good news is that it has never been easier to be a full-time trader. When I first started, I was trying to grow my own super small personal account, which I don't want to say it's impossible because it's not, but it's very, very difficult to grow a small account using proper risk management, something substantial that you can live off of. Now with funding companies like FTMO, Mint Funding, My Forex Funds, you name it, there's a whole bunch out there. It has never been easier to pass a funding challenge, get capital to trade with, and just receive a really nice profit payout from these companies. So if you do want to take it full time, that is something to seriously consider. I don't really believe in trading personal capital. I don't want to risk my capital when I could risk somebody else's. But if you can pass one of these challenges, you could be well on your way to trading full time. Another point that I wanted to make that was probably illustrated somewhat during this intro is that full-time trading isn't as flashy as many people think and many people hope. There's some pretty well-known YouTubers who I won't name, but are pretty big in the Forex space, and they're well known because of the flashy lifestyle. Now, I'm not saying that they're not funding this lifestyle through their trading. They very well possibly might be, but obviously they've got courses and whatnot. No shame there, I have a course as well, in the description down below. But I think for people that are considering leaving a legitimate job to trade full-time, I think that flashy lifestyle is unrealistic, at least at the very get-go. At the end of the day, I think it really comes down to your personality. Even if you're making a ton of money, it doesn't necessarily have to be flashy. Over 50% of people in the United States don't have $1,000 worth of savings. So when you think about that, you're gonna have two kinds of people. You're gonna have people that will receive a huge FTMO payout and spend it all in 1 month. Then you'll have other people that will save that money, invest it elsewhere. I am very, very adamant on going with the former, with going with the latter group. I think at the end of the day, it all comes down to whether or not you're trying to build status or if you're trying to build wealth. Personally, I really don't care that much for status. And it's not all penny pinching. I don't want you to think that if you trade full time, you have to be cheap. 2 years ago, I wouldn't have felt comfortable, or I wouldn't have really necessarily had the means to afford a gym membership that's $200 a month. Now, I don't really think about it that much. I don't really stress about it. Obviously, when the bill comes and I see it on my credit card, it's not great. I don't love it. But it's something that I now have the means to do, which of course I'm very grateful for. And if it wasn't for trading, and if I was just working a regular job, I probably wouldn't be going to that gym. All that to say, I think this channel originally started to gain a little bit of momentum because I'm kind of against that super flashy lifestyle. Again, to each their own, you can do whatever you want, but my encouragement here is to really manage your expectations. Don't think that if you're trading full-time, it's automatically going to allow you to buy a Rolex or anything super flashy. And if you do manage to manage your expectations in this way, have really realistic goals that you can actually hit, then I think it's going to be much easier and much more likely for you to get to a place where you can go full-time, where you can try and make trading your main source of income. The last thing that I have learned from trading full-time, trading $400,000, is that it is incredibly boring, and you therefore really need to put a large importance on having a routine. Stay hard! I've said it before and I will continue to say it over and over again. If you see traders online, videos that are posted with traders getting super excited about their profit, going crazy, it is very likely that they are super new and probably not going to last that long. It's great to be happy when you have a take profit hit, when you receive a payout, but if you're too emotionally connected and emotionally attached to those payouts or the potential of those payouts, it's only a matter of time until you start bending your rules, not following your trading plan, and therefore end up making mistakes. So if you can simplify your trading and make it as unemotional and therefore as boring as possible, I think that's going to make a massive, massive difference in your results. You have to be careful though, because if you do trade full-time, or if your trading just does become boring, a lot of people have a tendency to overtrade by looking at the charts too much. We feel that in order to justify us making money, we need to kind of work harder. And when it comes to trading, working harder typically means spending more time on the charts. But I really don't think that that is necessary. The more you look at things, the easier it is for you to maybe get into a trade that you shouldn't be getting into, and therefore making trading mistakes that are just going to hurt your bottom line. And so with boring trading comes a massive void in your life of just a huge amount of free time that really does need to be filled. And I didn't see anyone talk about this before I went full-time, and it's really something that I've had to kind of work on, and it's still something that I'm working on all the time. Before I started this channel, I was trading full-time for 9 months, and at first it was great. It was like a vacation. I didn't have a boss. I didn't have to go into work. It was great, but you can only go on so many walks. You can only, I mean, it was COVID, so basically I could only go on walks. I got super bored super quick. There's only so much Netflix you can watch, and so I decided to start this YouTube channel, which really filled up some of my time. And then I decided to go back to school to get my real estate license here in Montreal, and that took up a fair bit of my time, and now that just finished. And so I'm kind of at this stage again when I'm trying to figure out, well, what is it that I actually want to do with my time and my FTMO profit and everything. There's a lot of different options, but one thing has become very clear from trading full-time for 2 years, and that is that you need to do something with your time. Vast majority of traders are trading just because they want to make a lot of money, and there's nothing wrong with that. I think that's great. So why not use that free time to make money in other ways? It will actually make you a much better trader because you won't be so reliant on those FTMO profit splits, on those payouts. Be able to focus on other things. You can supplement your income. It makes a huge difference. You won't be as stressed. And so I really encourage those of you that are trading full-time, considering making that leap, to try and supplement your income, start a business, whatever it is, do something, because trading full-time will be very boring, which is a good thing. But in order to make sure you don't make unnecessary mistakes, you got to fill it with something. Trading with $400,000 is really an incredible thing that I think many of you can achieve if you just stick with it, stay patient, stay disciplined, and continue working on your trading. It's allowed me to have an incredible amount of freedom in my life, which I'm super grateful for, and to use some of my profits to pursue other passions that I have, as well as develop new projects, one of which I'm super excited to share with you guys in the near future. I'd love to hear from you guys in the comment section what you think about trading full-time. Is it something you're actively pursuing? Do you want to just keep it as a side part of your income? Or maybe you're shooting for the stars and do want to buy that AP watch with that Lambo. If you do, make sure to send me a picture on Instagram. In the meantime, check out this video here that will help you continue improving your trading to hopefully help you reach your goals. Until next time, peace.
The number one reason traders fail the FTMO challenge and never get funded is because of poor risk management. The 30 days stresses them out, and in an attempt to pass in just a couple of trades, they risk too much, and therefore they go around in circles in frustration and never getting funded. I am here to tell you that this is a terrible approach, and if you continue to let the 30 days stress you out, and if you continue to execute poor risk management, you are never going to hit that goal of becoming a funded trader. But fear not, because in this video, we are going to go over 2 different risk management approaches that I have both used to pass 4 100K FTMO challenges, so that you can set yourself up to become a funded trader in 2023 and dramatically increasing your chances of turning trading into a massive source of income for you. First off, I actually don't recommend you go with a company that has a time limit. A trader's ability to get funded shouldn't depend on what the market does or doesn't do over the course of just 30 days. Even the best trader in the world, if not enough setups arise, they're simply simply not going to be able to pass and they're going to fail their challenge. And I don't think that that is a fair assessment of a trader's ability. That's why I started Lark Funding, which unlike FTMO has no time limit. You can take as long as you need, and we only require you to pass one stage, unlike FTMO's two-stage evaluation. And every trader that I have spoken to that has taken the Lark Funding challenge has said that no longer having the 30-day time limit has been a massive game changer and has been way less stressful on them. So the link for that is down below, but let's now look at a couple of important frameworks and tips that you're going to want to keep in mind regardless of what risk management approach you take. The first is that 30 days is actually a lot longer than you think. Yes, 30 days will go by very quick. It is essentially only 4 trading weeks. However, traders get in their head that they have to pass week 1 or week 2, and that is what leads them to making tons of mistakes. The market can move and do a lot of things in just 30 days, which means that you cannot rush the process. Yes, the 30 days will arrive quick, but you can still take your time. In fact, if you do not want to make stupid mistakes that will cost you the entire challenge, it's imperative that you do take your time. Secondly, it is so important that you hold on to any winners that you have. You need to squeeze out as many percentage points from a winner that you have as possible. Because we only have the 30 days, we don't know when the next winning setup is going to come. So you need to be incredibly disciplined to not cut your winners too soon, because if we're going to hit that 10% mark, we need to make sure that we are doing everything that we possibly can to squeeze out as much juice from the market as possible. And thirdly, this is probably the tip that helped me the most when it came to getting funded, and that is that you need to do your very best to start your challenge with a winning trade. Now, I know that might sound silly. Obviously, you want to start your challenge with a winning trade. You want every trade to be a winning trade. But one thing that is nice about FTMO is that your challenge only starts when you take your first trade, which means you have the luxury of deciding when your challenge actually starts. And yet I see so many traders starting their challenge too early on a very weak setup because they're too excited and they are too anxious. But you need to ask yourself, what does a perfect setup look like in your head? A setup that just fits your trading plan absolutely perfectly. And however you answer that, that is the setup that you must wait for before starting your challenge. Because if your first trade is a loser, you're playing catch up from the very beginning, and it could take you a while to get back to break even. Before you know it, if you only have 2 weeks left, you might be better off just waiting for the free retry. If memory serves me correctly, every single challenge that I have taken started with a winning trade, and you can then use that momentum to build off of and to get you closer to the 10% mark that much faster. Okay, with all of that being said, let's now break down the 2 risk management strategies that have helped me get funded. The first is for slightly newer traders or for traders that are much more active and take a lot more trades. The parameters that you're going to need to respect is a minimum of 2-to-1 risk reward per trade, which is not being overly ambitious. And I like to remain conservative and say that you only need a minimum win rate of 50%. I think all of you watching, even if you are a newer trader, are able to find trades and setup that fit this criteria. And if you do this and you follow these 2 parameters, you are going to be able to pass the challenge in roughly 15 to 16 trades, which is just over 3 trades every week. And I know many traders that take at least 1 trade every day of the month, sometimes even 2 per day. So that is not unrealistic for many of you watching. On every single trade, you're going to risk 1%. At no point will you risk less. The reason I recommend you do this is because your win rate is quite low. So it is great to leverage your gains and risk more per trade, but because you're only winning 50% of your trades, it's really difficult to determine which setups are going to be more likely to work than others, which is why I recommend you just let the law of averages play out and you continue risking 1% per trade. For me, this is a lot of trades per month because I trade the higher time frames. And so some of you might be watching and thinking that is way too many trades, and that is totally okay. You do not need to follow this strategy. But if you're on a lower time frame, if you trade the lower time frames, this is absolutely manageable because some traders are just taking 3, 4, 5 trades every single day. So you will be able to pass the challenge using this framework. And I think a 50% win rate is super achievable. I'm not advocating like many traders out there that say, you need a 95% win rate with a 10-to-1 risk reward. This is super manageable, super doable, and I think it's very accessible for many of you. For those of you that aren't getting too excited with this strategy though, that is totally fine because it's actually the second strategy that I use for the majority of my challenges, and it's the strategy that I used that first got me funded. So strategy number 2 requires you to only take trades with a 3-to-1 risk to reward. Now, if you're a 2-to-1 risk to reward trader or 2.5 risk to reward trader, that's totally fine because the 3-to-1 risk to reward actually acts as a filter system. It's going to force you to only take the very best setups. If you see a setup that for you normally would be a 2-to-1, you have to ask yourself, does this have the potential legs to do a 3-to-1 or even more? If it does, that's a great setup. But if you say, no way, there's no way, it's counter trend, it's impossible for this trade to do a 3-to-1 risk to reward, then you are not going to take it, and that is how it acts as a phenomenal filter system. Now, you're ideally going to want to use this strategy with a 75% win rate. This can be achieved by trading the higher time frames, such as the 4-hour and above. And if you can hit these two criteria, you will literally be able to pass the challenge in just 2 trades. And the way you're going to do that is, unlike a strategy number 1, you're going to leverage your gains. So what you're going to do during your first trade, you're going to risk 1%. By risking 1%, you are risking it in order to make 3%, hence the 1 to 3 risk to reward. If that is a winning trade, which hopefully it is because you have a higher win rate, on your next trade, you're going to 3%. By risking that 3% on a 1 to 3 risk to reward, you could potentially be making 9%, even though you really only need to make 7% to pass. If it's a winning trade, well done, you have now passed the FTMO challenge. You are well on your way to becoming a funded trader. If it is a losing trade, however, not the end of the world, because you will now be back to break even. It's at this point that I highly encourage you to assess where you are in that 30-day time limit, or if you went with Lark Funding, you don't have a time limit whatsoever, you'll be totally okay. But if there's only 1 week left, or a week and a half, maybe even 2 weeks, you might be better off just remaining patient and waiting for that free retry rather than pushing things and trying to pass when you don't have that much time left. I think the number one goal with taking these challenges isn't actually passing and getting funded. It is wealth preservation, aka preserving the money that you paid for the evaluation. 3-to-1 risk to reward is getting slightly ambitious, but if you are a 2-to-1 risk to reward trader, I really think that you will be able to find these setups, and it's going to act as a filter system to really force you to only take the best setup. Strategy number 2 revolves around quality over quantity, and knowing that you can pass in just 2 trades, I think that is really going to help you remain patient. I think trading with funding companies and becoming a funded trader offers a tremendous opportunity to turn trading into a massive source of income for you. But trading is only a single piece to the puzzle. I think for many of us, we are not necessarily attached and overly obsessed with trading, even though I personally was at the beginning. I think the reason that many of us love trading is because it provides us with an opportunity to make a ton of money. But it's just a single tool, and we shouldn't rely solely on trading, especially when trading doesn't usually take that much time. That's why you need to watch this video here, where I share with you how I saved $100,000 at 23, so that you can do the same and even potentially, hopefully, do it faster than I did. Thank you for watching. I will see you in the next one. Play the long game. Good luck on those challenges, and I'll see you in the next one. Until then, peace.
Two years ago, I was broke, living with my parents and making only $16 an hour, but not anymore. Fast forward to today, and I am my own boss. I make my own schedule, and I have secured $400,000 of Forex funding. But none of it would have been possible if I hadn't learned these 3 lessons, which cost me over $10,000 in Forex courses, countless blown accounts, and years of frustration. So in an effort to save you tons of money and years of pain, I'm going to teach you exactly what I did to go from $0 to $400,000 in funding. The entire process revolves around obtaining funding, whether it be from FTMO, my Forex funds, or Lark Funding. This is what you need to do, and at all times it is your North Star. The question is, how can we accomplish this? Why is it that over 95% of traders consistently fail and never achieve their goals in trading? When thinking about it, I think there are 5 common reasons for why traders always fail. And the first one is fundamentally and foundationally, traders do not take the time to properly learn how to trade. We often see these trading challenges that are super enticing and pull us in. We can calculate in our minds the potential profit that we can generate, and therefore we do not take the time and we do not have the discipline to actually develop our trading skills before jumping ship and taking one of these challenges. So you need to take the time and have the discipline to develop your own trading strategy, know and understand what your trading edge is, so you can implement it day in and day out. Skipping this step is basically a guaranteed path to never succeeding in trading. So if you are a newer viewer, make sure that you do not skip this step. Secondly, traders do not have risk management, and this is the downfall of the vast majority of traders. I think the reason that people do not have risk management is due to a lack of discipline and a lack of patience. In the world that we live in today, it's all about instant gratification. We want to achieve that goal and that vision overnight. But when it comes to trading, that simply is not possible. Sure, if you want to gamble and put your entire account on one trade, maybe you'll get lucky. But if you want to be a professional, if you want to succeed long term and make this a business, you need to adopt proper risk management. Yes, it can be be a boring topic, and due to its boredom, I think it is why so many traders skip it. If you are risking more than 2% a trade, I think you are doing something massively wrong, and in the long term, it is not going to play out for you. So remember, risk management is always number one. The third reason that traders often fail is due to poor market timing. Now, this isn't necessarily your fault. Let's say you sign up for an FTMO challenge, you have to generate 10% in 30 days. Even if you're the best trader in the world, if the market is flat, consolidating, and there's not enough setups for you, you're simply not going to generate and earn that 10% return, and therefore you're not going to pass. But I do not think that this is the fault of the trader, and I think that is why many companies set themselves up like this, because it gives them the edge. But at Lark Funding, which is my funding company, unlike most companies, we don't have 2 stages that you need to pass. We only have 1 stage, and there is no time limit. If it takes you 3 months, 6 months, or a year to pass, that is A-okay with us, because we want professional traders, and we believe that traders should not be at the whim of market conditions. You should have as much time as you need to prove yourself and generate that 10% return. So if you're interested in that, the link is in the bio. The fourth reason that most traders fail is that emotions get to them. When I started trading, and even well into my trading journey, I would get beyond frustrated and angry when I would have a losing trade. Now the thing is, I knew intellectually that in trading there's going to be losses, and they are 100% unavoidable. However, I didn't know it intuitively, and it's when there's that disconnect that you can really get a lot of frustration, because it's a paradox. You know it on one end, but you don't know it on the other. And I'm sure all of you watching know intellectually that in trading it's impossible to have a 100% win rate. But why is it that when you have a losing trade, you get frustrated or upset, or you jump ship and you change strategy? Because you don't yet know it intuitively. And I think part of that is due to attachment. I wanted to succeed in trading so bad that I was so attached to the outcome. I was attached to the output rather than the input. And the output is often outside of our control. So I would encourage you to change and shift how you set goals. Instead of setting things that are outside of your control, such as how much money you're going to make each month, what percentage returns you can generate, those are all outside of your control. Set goals in relation to your trading plan, how well you execute trades, in relation to your risk management. Something that is 100% within your control is how you should be setting goals. If you do that, then you can focus on those. You'll become less attached to the outcome because you'll actually see success, and therefore you will become less emotional. It's a bit of a process, but if you apply it, it will make a massive difference in your trading. And lastly, the fifth reason why traders often fail and never achieve their trading goals is because they do not stick to their strategy long enough, and they don't allow their edge to play out. The only Forex book that I recommend is Trading in the Zone, and in the book, the author talks about this idea and notion that traders need to adopt the same mindset and business plan that casinos have. Now, more specifically, the way a casino operates is that they simply do not care whether they make hand at the next table or over the next week or over the next month, because they know that over time, at the end of the year, over a large enough sample size, their edge is going to play out. Now, this is the exact same mindset that you need to have with trading. You need to know that there's going to be plenty of losses, but with a large enough sample size, your edge is going to play out. Even if you only have a 50% win rate, but you have a positive risk to reward, over a large enough sample size, you're going to be profitable. So you can't focus on the next trade, the next 3 trades, or even the next 10 trades. It is outside of our control how each trade plays out. So you need to think long term and allow the numbers to play themselves out. If you don't, you're going to fail. All this to say, when you combine these 5 reasons for failure, it is now your job to identify your strengths and weaknesses. And this brings us to a lesson that I really like from Alex Hormozi that says that what you need to do when running a business is you need to ask yourself, what is it that you need to do or not do for your business to fail miserably? It's a much easier question to ask and answer than the question of what is it that I need to do to succeed? So you want to apply that to your trading. Ask yourself, what is it that you need to do on a consistent basis if you were to fail? Imagine a situation where you have already failed. What is the most likely reason for that failure? What is it that you did? What is it that you did not do? You can answer that question, you're going to be able to identify what your strengths and weaknesses are, and then you can work from there. Now that we know what the most likely reasons for failure are, it is now time to focus on the 3-step process that is going to get you funded and well on your way to being a profitable trader and maybe even quitting your job one day. The first step is to do absolutely everything in your power to get funded. Now you might think that this would be the last step, but really this is the first step. We're skipping all of the basic foundational elements when it comes to learning how to trade. We are assuming in this video that you have a decent understanding of trading and you're on your way to hopefully taking a challenge soon, or maybe you're even in the process of doing so currently. It doesn't matter how you trade. You can be a scalper, a day trader, or a swing trader. All that matters is that you secure this funding, because that is going to be the reason and the anchor that will allow you to make a ton of money. But we shouldn't go too fast. There are some minor details in the nitty-gritty that can be the difference between you passing and failing. Specifically, there's 3 things that you need to keep in mind. The first question is, how do you know when you're ready to take a challenge? I took my first FTMO challenges about 1.5 years, 2 years ago, when I reached the point of being consistently profitable every single week. I wasn't focused on making 10% a month or consistently passing FTMO demo challenges for free on their website, because I knew that when the challenge started, I could play around with my risk management, with my risk per trade, and I could achieve that 10%. So all I needed to know was that I was consistently profitable. Now, there are going to be weeks when you aren't positive, but if you know that you're consistently profitable over a long enough period of time, every month you're seeing green, I think that is a good starting point for when you can consider taking a challenge. Secondly, when you're emotionally stable and you're not letting losing trades play with your emotions and play with your strategy, that's also another good sign that you're ready for a challenge. And third, as mentioned, if you are always sticking with your strategy and not playing around and you have a good foundation, that is another good sign that you're going to be ready to take a challenge. You don't want to fail a challenge and lose a whole bunch of money simply due to your emotions. It's totally unnecessary and a complete waste of money. The second question that you need to consider when it comes to getting funding is, what company do you go with? When I secured my funding with FTMO, this was much less of an important discussion, but now it can actually be the difference between passing and failing. The main difference between what company you go with is whether you go with a company that has a time restriction or a company that has no time restriction. There are pros and cons to both. With time restricted challenges, you have higher leverage, but honestly, I think leverage in many ways is a scam, and traders don't actually understand how leverage works. If you're using 101 leverage to its full capacity, you're playing with fire and you're not a professional trader. You can leave hate comments down below. It's totally cool. It's all love here. I much prefer challenges that don't have a time restriction, because you can actually take your time. You're not at the whim of the market, and it's actually going to give you a much better opportunity at getting funded. There's a reason that Lark Funding has double the pass rate of FTMO, and it's because we don't have 2 stages. You're not on a time restriction. Yes, potentially you need to have slightly lower lot sizes per trade, but you are much more likely to actually secure funding. There are many videos on this channel and other channels throughout YouTube that review different companies, so I highly encourage you to do your research and figure out what company is going to be the best for you. Okay, the third step is, when do you actually take the challenge? You're profitable, you've decided what company to go with, but when do you actually start? Again, this can also be the difference between passing and failing. When I took my FTMO challenges, I was absolutely ruthless in my discipline and filter when it came to deciding when to start the challenge. The luxury of FTMO is that the challenge only starts when you take your first trade. So many traders start their challenge on a trade that isn't that solid, which is just dumb. It's not the way you should be doing things. Whereas if you wait patiently and look for a setup that is absolutely perfect, it's gonna make a huge difference, because you wanna be starting your challenge with momentum. You wanna start it ideally with a winning trade. So I would often trade the 4-hour and the daily time frame, but when it came to starting my challenge, I would often wait for daily and weekly setups. And there was not one challenge that I have taken where the first trade wasn't a winning trade. Sometimes I would have to wait a month, maybe even 2 months before starting the challenge, but I knew that I was going to start it on a positive note, and that was going to give me the momentum I needed to hopefully get funding, and that's exactly what happened. Now, if you go with a company like Lark Funding that has no time restriction, this question is much less important because you can start whenever you would like, you can trade slowly, you can take your time, and you're not gonna have to condense all of your trading within a 30-day period. So if you do go with a company that doesn't have a time restriction, don't worry so much about this one. Okay, so step 2 from going from $0 to $400,000 in funding. Most traders fail, but it might not be for the reason that you think. Yes, trading is difficult, but we can't forget the Pareto principle. You are going to achieve 80% of trading results, your ideal trading results, from only putting in 20% of the possible effort. And that is why you need to do what 95% of traders aren't willing to do in order to enter the 5%. That is step 2. Firstly, you know what it is that you need to do. People that are unhealthy know that eating a bag of chips every single night isn't going to lead to them losing weight, and it's not going to make them feel better, look better, or be any healthier. They know that they should exercise, they know that they should eat healthier, and none of this is a secret in any shape or form. And trading is the exact same way. It's not a secret. You know that over-risking, over-leveraging, revenge trading, all of these things are going to lead to your failure and your demise. And yet traders continue to do it, potentially and likely it's human nature. We get so caught up and so deep into our patterns that we often can't dig ourselves out or take a bird's eye view to really understand what it is that's leading to our failure. I think people often do this because they don't want to come to terms with the fact that trading is a long-term game. It's often marketed and advertised as a get-rich-quick scheme, but it simply is not, no matter which way you cut it. It is a long-term game, and that's why people end up doing things that aren't going to help them actually make any money whatsoever. If you go to the gym consistently for 6 months, you are going to get a physique that is in the top 5% of society. And doing that is not difficult. You have to be consistent, but it's not rocket science. That is why, again, unpopular opinion, I always say to some of my friends that I don't believe in personal training, because all you need to do is go to the gym, lift something heavy, and eat enough food to grow. It's as simple as that. And if you do that over a consistent period of time, you're gonna be in the 5%. And trading is the exact same way. If you were to trade a 38 or 61 fib retracement on the daily time frame for 5 years, I bet you would make a ton of money. But why doesn't anybody do it? Because it's so simple and it requires a lot of time, and very few people are willing to put in that time. So you have to play the long game. You have to do what 95% of people aren't willing to do in order to enter that 5% group. The third step that I use to go from $0 to $400,000 is realizing that the less I want it, the more I'm actually going to have it. This last step is the most critical, because even if you are the greatest trader in the entire world, if you're massively attached to the outcome, it is going to impact your decision making, and therefore you're not going to be as effective of a trader as you possibly could be. Most traders set goals like, I want to make 2% every week, or I want to make $10,000 a month. But as I mentioned, this is 100% outside of your control. I set goals like this for the longest time, for years, and I very rarely hit them. And it led me to think that I wasn't a good trader, and it led to me changing strategies, jumping ship, and never letting my edge play out. In doing this and having the same mindset that I had, you're indirectly shooting yourself in the foot, and you could very possibly be a phenomenal trader, but because you're adopting these things, you're never allowing yourself to consistently see and find success. So how do we solve this? We have to be unattached to the outcomes. There is a great story and example in the Bhagavad Gita, which is a phenomenal book. I highly recommend the Stephen Mitchell translation. And basically the entire thesis and outline of the book is that we are entitled to our actions, but not the fruits of our actions. This is a very ancient philosophy and idea, and yet it applies so well to the present day, especially trading. So remember, you are entitled to the actions that come with trading. What trade you take, what pairs you trade, your risk management, your trading plan, all of these things you are entitled to, but the second you press buy or sell, you are not entitled to the result of those actions. You have to be unattached, and you have to come to terms with that fact, not intellectually, but intuitively. comfortably. That is why I encourage all of you to focus on inputs when it comes to goal setting rather than outputs. Write down on a piece of paper what it is that you can actually control in your trading. If you focus on those things, it's going to make a massive difference in your mindset and your approach, and trust me, it will make a huge difference in your trading results. I went from $0 to $400,000 in Forex funding that now allows me to be my own boss, make my own schedule, and I save over 80% of my income, which has also allowed me to build a stock portfolio of close to $100,000 all at the age of 23. I highly encourage you to watch this video somewhere around here where I share with you a couple more frameworks that help me save over 80% of my income every single month to help me work towards my ultimate goal of financial independence. Thanks for watching. Play the long game. I'll see you in the next one, and until then, peace.
Let's talk about trading funded Forex accounts. I have now been trading a funded $200,000 FTMO account for almost 2 years, crushing the over 90% failure rate and initially using it to quit my job and trade full time. There's tons of talk online about how to get funded, but what about what actually happens once you do get funded? I used to stay up at night with countless thoughts and dreams of what it would be like once I got funded. Some of those became reality, while others, turns out my expectations were completely off. So today we're going to talk about the 4 main takeaways that I have learned from trading funded Forex accounts for over 2 years. All of these will not only help you get funded, but once you do, will help you remain in that 1% of traders that consistently pulls out money from the market, and will hopefully get you into a position where you will be that much closer quitting your job and becoming a full-time trader. The first main takeaway is that you quickly learn on funded accounts that you cannot get too eager. When you first pass the FTMO challenge, they send you an email congratulating you on your success, but it is at this point that many traders over risk due to overexcitement, and they completely blow their account and lose all of the progress that they just made in obtaining that account. In order to not get too eager, funded accounts force you to remain absolutely and crucially disciplined and patient. This means that you cannot at any time waver from your trading plan. If you've been trading for a while and have tried to pass funding challenges, there's a very good chance that you've actually been messing with your strategy and not allowing your edge to play out. And traders will continue to do this once they get a funded account, and it is the absolute demise of so many traders. They think that over the hill there's something way shinier, and they just jump ship rather than letting the law of averages play out. This becomes even easier during a funded account because you're only 1 trade away from making money, whereas during a challenge you actually have to make 10% before you're even relatively close to seeing that live account. In order to alleviate this keen eagerness, which is fine, it's exciting to get funded, you need to work on your attachment. You can't get overly attached to the potential results that you may or may not see. And the only way to do this is to properly set goals. If you say you want to make $5,000 in your first month, it's an absolutely stupid goal because the market doesn't care what you think. The market doesn't care how you trade. So you're much better off focusing on your trading strategy, your trading plan, focus on the inputs and everything that is within your control, and that is what's going to allow you to remain patient, not get overly eager, and you'll keep that funded account. The second takeaway is that every payout resets the clock. When you're trading a funded account, you are constantly changing strategies between growth and profit preservation. Every time you receive a payout and your account goes back to the initial balance, it is now that much more stressful because your first trade, if it's a loser, you're now in the negative. You are now 1 step closer to blowing that funded account. Whereas if you're up $10,000, yes, you're not stressed about losing the account, but you are stressed about losing the profit that you have worked so hard for. And at least for me personally, that dramatically changes the mindset that I use to approach my trading. If I'm running a profit and I'm only 3 days away from a profit split, it would be stupid for me to risk those profits to just make an extra 1 or 2%. I'm much better off waiting and pulling that money out from the market. Whereas if I'm down 1 or 2%, I need to push forward. I need to be on the offensive and not go overly too defensive and just get scared and not take any trades. No, this doesn't mean that you should leave a buffer in your account. I really strongly believe that this is not the way to do things because trading is hard enough as it is. You do not want to play with the law of averages that suggests that over time you are going to lose money. The market will beat you. And so once you generate profits, you're far better off withdrawing them from your account and having them hit your bank account. But a funded account is a little bit more difficult in the the sense that when you're taking a challenge, your North Star is always the same. It's always 10%, whereas with that funded account, it's constantly changing. The third change is the mindset shift that takes place when you are trading a funded account. It is very different than a challenge account where, as I said, the North Star is always 10%, but for me, when I'm taking a challenge, it's also capital preservation, investment preservation. You paid $500, $700, whatever the amount is for that challenge, and many companies offer a free retrial if you don't pass, but you follow all of the rules. And so for me, my number one goal isn't always to pass and make 10%, but it's actually to ensure that under no circumstances do I blow that account and blow the investment that I put into that challenge. I think if you adopt that mindset, it's going to force you to be a little bit more patient, and you're actually overall going to be a better trader. Even though you might not pass on your first time, it's going to allow you to eventually pass. But the focus that is required when trading a live funded account is very different than a challenge account. And personally, I find that they're both equally taxing in terms of energy, but it's a very different skill set between taking challenges and trading a funded account, which is why this year in 2022, I haven't taken a lot of new challenges. I've just continued to trade the capital that I have. Potentially in the new year, I will take more, but I've just been focused on trading the account that I already have and trying to take money out from the market. That is why we trade as traders. It is to make money. And so it's great to grow your overall capital base, but I think there needs to come a time when you hunker down, focus on what you have, start to make some actual income, gain some momentum, and then you could go back to the drawing board and try to obtain more funding. The fourth takeaway is that trading is incredibly inconsistent. Not necessarily your trading strategy or your approach, which should remain very consistent. It's the markets as a whole. You could have a fantastic week or month, and then things could be dry for the next 3 months, which is why setting a set profit target or financial goal every single month is absolutely pointless, because the market is constantly shifting and changing, and it doesn't care what you think. As traders, we dream of making thousands of dollars every single day, but that is simply not the reality, even once you become a funded Forex trader.
Risk disclosure.
For many of you watching, you likely want to become a full-time Forex trader, or at the bare minimum, quit your job and make enough income doing something else that allows you to quit your job. And trading is a fantastic opportunity and source of doing this. But the main takeaway that I want to share here is that you are trading not necessarily because you love trading, but because of the opportunity that it provides to make money. And so I highly encourage all of you that want to pursue full-time trading to start a business on the side, because trading is so inconsistent. As a full-time trader, initially I was 100% relying and focusing on my trading income, and that put a tremendous amount of stress on my life. You are much better off supplementing your income and not relying 100% on that trading income, because things could be dry for a week, a month, 3 months, however long the market takes to start moving, how you need it to move according to your strategy. So that is why the fourth takeaway ultimately is that you're trading to make money. Don't be attached solely to trading. Continue to use the downtime that trading provides you to start a business and increase your overall income. But all of this to say, I see so many traders fail their challenges and fail their funded account simply because they don't stick with their strategy, which is the result of not having a long-term mindset. Over the last 2 years, I, however, have managed to break this cycle and break this statistic by sticking with the exact same strategy that I have outlined throughout numerous videos on this channel, and of course by playing the long game, which is an absolute must. The longer you play the game, the more you will realize that trading is just a tool amongst many that we can use to make a ton of money, which is why you need to watch this video here that is going to teach you how to enter the 1%. Thanks for watching. Play the long game. I'll see you in the next one, and until then, peace.
Unlimited potential, unlimited money. So many people are tired of the 9 to 5, of having a boss.
People say, I am the best boss. They go, God, we've never worked in a place like this before.
Of doing the same boring grind day in and day out. And that's where trading comes in. Trading is a panacea, an outlet to solve the vast majority of your problems. With nobody telling you how much money you can make, the sky's the limit. You can be your own boss, make your own schedule, and live by your rules. And that's why it is so popular, but it is also why the vast majority of traders completely fail. The attractiveness of trading makes it a perfect breeding ground for instant gratification, but when that dopamine hit doesn't come, most traders just move on to the next get-rich-quick scheme. Warren Buffett has this amazing quote where he says that the game you play is much more important than how hard you play it. So in this video, I'm gonna tell you why trading is a game that's worth playing and how you can align yourself with the slim 5% minority of traders that consistently pull money out from the market and consistently hit their goals. I started trading way back in 2016 when Trump was president, men were men, and boys could be boys. I'm just kidding.
Wait a minute.
I got into trading because a friend at the time was making some consistent profits, and of course I stumbled upon a few different Instagram accounts and I was immediately hooked. I totally devoured baby pips. I read as much information as I could, and pretty much from the exact get-go, it was only a bumpy ride. From blowing $500 accounts, mixing up strategies every couple of months, and not even considering proper risk management,
Risk disclosure.
I thought I was always just a handful of full margin trades away from making it into Sean Lee territory. Is that guy even still around? It's fair to say that I was in the vast majority, the huge, juicy community that consists of 95% of all traders that just consistently lose tons of money. And it was just super frustrating. And so of course, like most traders, I just continued to jump from one strategy to the next, thinking that the next one was going to be the holy grail. And you know what I learned? I learned that absolutely everything that I was doing was wrong. From scalping, trading low time frames, switching strategies, going full margin, you name it, I made all of the mistakes you can make, which in hindsight was a very good thing. I learned though that as usual, if you want to be in a minority, you have to do what only a minority of people are willing to do. And the bad news is that I was doing everything that the majority was doing. And that's how I found the smart money concept style of trading, which completely transformed my life and allowed me to quit my job, buy a Lamborghini, and live the life of my dreams. And of course, none of that is true. If I was British, I would describe that strategy as a load of bollocks, but that is a topic for another video. But the lesson here is that I learned that I needed to make some changes. And it's the changes that I made once I came to this realization that did actually allow me to eventually quit my job and become a full-time trader. How long do you think it takes to become an engineer or a doctor? Do you think med students quit and drop out of school because they're not allowed to perform brain surgery the first day on the job? Absolutely not. And that is because it is a game of iterations, and trading is no different. 5% of traders make money consistently, and that is a slim minority. And so if you want to be in that minority, you simply cannot follow and do what the vast majority of traders are doing, how they're thinking, and what they're following. Simply going against retail sentiment might get you somewhere, but I think you need to go beyond this. Ask yourself what the majority of retail traders are doing when it comes to every aspect of trading. Now, doing this, don't fall into the smart money concept trap where you can ask 10 traders what's going on in the market and receive 10 different results. Take anything you can from an objective standpoint, ask yourself what traders are doing, and simply do the opposite. It is exactly like that classic episode in Seinfeld when George realizes that every mistake that he has made in his life has been the wrong one, and so he decides to just do the opposite of his instincts. So he sees a cute woman walk into the coffee shop, and instead of being fearful and not going up to talk to her, he goes straight up to her, tells her,
My name is George. I'm unemployed and I live with my parents.
I'm Victoria. Hi.
and it works perfectly. He gets her number and they end up going out on a date. And trading is kind of similar to that. You need to ask yourself, what are the majority doing? Because the majority of traders are losing money. And so if you can shift your mindset, shift your understanding, and fit yourself in that minority, I think it's going to make a massive difference in your trading. Now, this is going to be a delicate dance because there are traders online that show you what they're doing, and these traders are consistent and they are profitable and they're sharing useful information. So it's your job job as a trader and it's your job as a consumer to be ruthless in your filtering to determine what is useful and what is just absolutely useless. It's a difficult thing to do, but the deeper down the rabbit hole of trading that you go, the more experience you have, you'll develop this filter and you'll start to gain a good understanding for what's legit and what is worthwhile. I spent over $10,000 on courses trying to learn, trying to develop my strategy and system, and a good half of that money was spent on complete garbage and complete nonsense, but it's really just part of the game, and I feel like it's a rite of passage for traders to waste money in their learning process because it really is difficult to find good information online. You need to be careful though, because for many of you watching, the answer to your problems might not just be another course. Very quick break to mention today's sponsor, Neo Financial. I'm a huge advocate for purchasing absolutely everything on a credit card, so you can not only take advantage of a rewards program, but so you can also build up your credit to more easily be able to secure a loan when you need one in the future. And when it comes to a rewards program, the best cashback card in the game currently is Neo Financial's cashback card. Now for all my fellow Canadians out there watching this, you seriously need to check them out. You earn a guaranteed 1% cashback on all of the purchases that you make, and that cashback rate can actually jump as high as 15% if you purchase at one of their multiple partners. If you sign up today using the link down below, you'll receive a nice $50 welcome bonus, and you can get instantly approved for up to $8,000. While you're at it, they also have a high interest savings account, the Neo Money account, and their interest rate just jumped from 1.45% to 1.8%, which is way higher than I was getting at BMO. It's like 10 times higher. Neo, a huge thank you for sponsoring this video, for supporting the channel. I love what you guys are doing, and I highly encourage all of you to check out those links down below and enjoy that nice $50 welcome bonus. When you break it down, there are only two groups of traders. There are traders that continue to make mistakes by doing things that they know they simply should not be doing, and the second group consists of traders that simply are too new to trading and don't yet know that what they're doing is incorrect. Let's take the most obvious example. Risk management. Everybody knows that they need to practice proper risk management in order to stay in the game long term. Many traders that don't follow proper risk management simply say that it is because they're trading a small account, it's personal capital, and they need to risk more in order to grow their account. But I think I have a very good perspective on this, because since launching Lark Funding, I can see all of your stats. Every trader that is signed up, I can see every trade that you take. And what I have come to learn is that the traders that say they will be properly risk managed once they have a larger account, it's a total lie. You hand somebody a $100,000 account, and if they weren't implementing proper risk management before, if you hand them that large account, they're not all of a sudden going to become a god in risk management. They're going to continue to over risk because they haven't actually developed that skill and that discipline. And to be brutally honest, this is just dumb, because proper risk management is probably the easiest skill you can develop as a trader. It's always the #1 touted rule when it comes to trading, and yet so few traders actually follow it. Why do so many traders do things that they know are bad for them? I think this just comes down to human nature. If you look around you, we all know that we should exercise on a daily basis. We should eat healthy, but if you look at, obesity rates, people just aren't doing things that they should be doing. So that's pretty straightforward. When it comes to the other group of traders that don't really know that they're making mistakes, there's no harm there. They're simply too new to trading. They haven't taken enough courses or absorbed enough information to really know that what they're doing, they should not be doing. I think this one is a little bit easier to fix. So if we focus on the first group, if you do fall under this category, there's one simple question that I want to ask you. Do you care more about your ego, or do you care more about your goals? Because if you care more about your ego, you're going to continue to over risk. You're going to continue to not follow your trading plan in an attempt to make some quick money, to just make massive, unrealistic returns. However, if you do care ultimately more about your goals, then there's no reason for you to not follow your trading plan, because that is the only way that you're actually going to arrive at the destination that you want. There are often weeks when I won't take a single trade, and yes, that is super boring money, and it's not what we want to do as traders. We want to get into the market and we simply want to take trades. It's what we enjoy doing. But it's these quiet weeks and difficult consolidation weeks when the majority of traders that have earned money in the markets tend to give back those profits because they're not disciplined and they're taking trades that they shouldn't be. Again, these are all things that the majority is doing, but the minority simply isn't. Trading is a game worth playing because of its lack of limitations, but the freedom that comes with that tends to get the vast majority of traders into trouble. If you're currently struggling, I really encourage you to stick with it, but you need to sit down and really analyze objectively what is going wrong and what kind of changes you need to make with your trading. Are you still doing things that you simply know you should not be doing, or are you earlier on the learning path and you still don't know the mistakes that you're making? You still don't necessarily know what the right approach is. Regardless of what category you fall into, it doesn't really matter, but if you can identify where you fall, this is when you can start making the changes that are necessary. Knowing that the majority of traders do not make money, position yourself in the minority, and this can easily be done through risk management and discipline. Remember, great trading is boring trading. So for all of you struggling out there, I highly encourage you to stick with it. I'll see you in the next one. Thanks for watching. Peace. Do you keep failing your FTMO challenge, or maybe you're just too stressed to even pay the fee to sign up to then take your challenge? I've been there, most traders have been there, and it's totally understandable because, let's face it, the FTMO or my Forex funds or any funding company challenge is expensive. So it can be super annoying and frustrating to pay the fee, sign up, and then to just fail. So today we're going to be talking about 3 reasons why this happens and 3 ways and reasons for how we can avoid this. Because let's face it, the stress is not going to be helpful to your trading, it's not going to be helpful to your personal life. It's not going to be helpful for anybody, especially your trading results. So let's dive in and figure out what's going on. The first problem when it comes to stress during the FTMO challenge is because so many traders take it long before they're even ready to be taking the challenge. I see it all the time. Traders sending me messages saying, hey, I've been trading for 1 or 2 months. I've had a little bit of success. Should I take the challenge? More times than not, my answer is no. If you're relatively new to trading or just trying out a new strategy or trying to gain some momentum and consistency, that is not the right time to be taking a challenge because 1, it costs money and you're likely to lose it. And secondly, because, well, if you don't really know how to trade yet, then why do you think that magically if you get a funded account, then you'll just learn how to trade? It might sound crazy to some of you watching, but that really is, whether consciously or unconsciously, the thought process of many traders. I get asked all the time, how did I decide when to take my FTMO challenges? And the answer to that is when I was ending each week consistently profitable. Now, many traders think that because the FTMO profit target is 10%, they need to be making 10% every month in order to take the challenge. That is simply not the case. You see, when you take the challenge, and I've made videos on this, you need to leverage your gains. So you're not risking 1% every single trade. Once you're up a few percentage points, that's when you start increasing your risk accordingly. So don't think that you need to be crushing it with high return figures every single month before you can take the challenge. I think if you're consistently turning a profit, for the most part every week, every month you're seeing green, then I think it could be a good time to consider taking a challenge because you clearly know what you're doing. If you're consistently profitable, you're already in like the 5 or 4% of traders, so you're at a really good starting point. So if you're a bit newer to trading, if things are still a little fresh for you and you're still trying to figure things out, I urge you to not take the challenge just yet because so much stress that people experience is just because they're not ready. Whereas if you wait till you're consistent and profitable and confident in your trading, well, then that's going to get rid of so much of the stress because you know what you're doing, so there's no point in being overly stressed about it. FTMO just a couple of months ago announced a brand new rule that is actually a major game changer, and I don't think it's discussed enough amongst traders because it can actually fundamentally change the way that you approach the FTMO challenge. The new rule, if you're not aware, is that you will receive a 2-week trading extension, 2-week extension on your challenge if your challenge is up over 5% with 3 days to go. What's major about this new rule change is the way that it can actually change your approach in terms of risk management and strategy efficiency when doing the challenge. So if you think about it, before you had to generate 10% in 30 days. Now you don't actually have to do that. Yes, that's still a requirement. In order to move on to phase 2, you need to generate 10%, but really all you need to do is generate 5% in a month. You need to generate 5% in 30 days, because if you do that, you're then going to receive your 2-week extension, and then you'll have 2 weeks to make another 5% and to pass. So for those of you watching that are stressed out during your challenge or stressed out about the idea of potentially not hitting that 10% target, all you need to really tell yourself and digest is that you only need to generate 5% in a month. And that should be totally doable. It's not overly optimistic, especially if you use the risk management strategy that I've made a couple of videos on before. I'll try and link them around, but really you're not risking 1% until you make it to 10%. You increase your risk as the challenge goes on, and so hitting that 5% in 30 days, totally reasonable, and then making an extra 5% once you're up 5% with 2 weeks left is actually quite easy. On top of that, if you get to that point when you're up 5% and you receive that 2-week extension, there should literally be no stress whatsoever, because worst case scenario, you will receive a free retry. There should be none of you watching that are up 5%, you receive your 2-week extension, and then actually blow the account and have to pay for a new challenge. That should never ever happen. Sure, maybe there's an outlier event where you forgot to place your stop loss or there was a glitch or whatever, but 99.9% of the time, you should never ever have to pay for another challenge once you're up 5%. You should be protecting that capital. You should be protecting those gains. So there shouldn't be any stress about failing the challenge and having to repay for another one. If you can shift your mindset to no longer thinking about 10% in 30 days, but 5% in 30 days, that should alleviate a lot of the stress. It should help you a lot out with your challenge. What makes trading so difficult is that our effort and our progress, unlike most things in life, are not a linear progression. The harder you work in trading, you won't necessarily become a better trader or have better trading results. It's taken me a long time to figure this out, and really the less time I spend on the charts lately, the better my results are. And this is a difficult pill for a lot of traders to swallow. Especially for me, if you're just a hard worker, often you can think that you can just will your way to trading success. And don't get me wrong, when you're first starting, it does take an incredible effort to build up that momentum, to build up that knowledge, that foundation, to learn how to trade. But you'll quickly reach a point of diminishing returns where you spend 8 hours a day staring at the charts, and it leads you to making silly and stupid mistakes that if you had just gotten away from the computer, you wouldn't have made. This connects directly to our trading results and how we need to be very disciplined in not only how we set goals, but where our focus goes. You see, if you're spending 6 hours a day on the charts and you're not seeing the results that you want, it's not very likely that if you spend 8 hours a day, you're going to all of a sudden improve. At the end of the day, the result of our trading and the result of your challenge are 100% outside of your control. And that's what's so difficult. You have to come to terms with that fact that no matter how hard you work, you cannot control what the market does, and therefore you cannot control the results of your trading. This brings us to potentially the most important point of this entire video, and that is inputs versus outputs. What we focus our attention and energy on, and how we actually set goals. So I think it is so important. It's actually crucial for you to focus on the inputs of trading rather than the outputs. So many traders, when they start, myself especially, we say, oh, every month I want to make 10%, 15%, but that is actually 100% outside of our control. We can't determine how many setups the market gives us one month, how those setups play out, all the factors of what's going on in the world that impact the market, outside of our control. What you can control are your inputs. So you can control your trading plan. You can control how you execute your trades. You can control what kind of fundamental analysis you do, how you manage your trades. All of those things are within your control, and those are the things that you need to be focusing on. Not how many pips you're aiming for each day, each week, and that kind of thing. So to connect this to the FTMO challenge, you see, no matter how bad you want it, the results of your challenge are outside of your control. It's possible that you could crush it this month, take an FTMO challenge next month, and then just not do very well. It might not actually be your fault. Maybe next month there won't be any setups. I know right now, if I were to take an FTMO challenge, this month, I probably wouldn't be doing very well at all. There's been no setups for me. I've had only 2 trades this month, and so I'd be likely to not hit that 10% target. And you need to be okay with that. You need to really swallow that pill and understand that no matter how hard you work, you cannot control your results. It's the opposite of so many things in life, and that's what makes trading so very difficult. But if you shift your focus into inputs rather than outputs, focus on everything that is within your control, it will not only transform your entire trading, but just approaching life like that has helped me out a lot. It's a very stoic approach. Connects very well to yogic philosophy as well, saying that you're entitled to your actions but not the fruits of your actions. It's really profound and it's helped me out in a lot of ways. So I urge you to think about that when you're approaching your FTMO challenge. It's gonna be an absolute game changer for you. Even though I know you guys loved this video, the #1 most important thing when it comes to passing the FTMO challenge is always risk management. So check out this video where I show you the ultimate risk strategy for the FTMO challenge. I'm 23 years old and I'm currently trading Forex full time with $400,000, but it wasn't always like this. The vast majority of my trading journey has been frustrated, lost, and with a bank account that continually kept dropping. But that is no longer the case. How did I get to this point? In this video, I'm gonna tell you how I went from 0 to $400,000 and 3 lessons to help you do the same. It's time for a little story time. When I was back in school at around 18 years old, I had a friend that one day during class was not paying attention at all, and he was just always on his laptop. So eventually I asked him, what the heck are you doing? And he told me that he was trading Forex. Now at the time I had heard a little bit about it. I thought it was a scam. I thought it was kind of impossible. But he told me that he grew like $500 to $10,000, and I did not believe him at all. So he opened up his laptop and he showed me his C-Trader balance, and lo and behold, it was $10,000. And from that very second, I was hooked. For the rest of the semester, just like him, I didn't pay attention. We were both on our laptops trying to trade different pairs to make some money. And in the meantime, to make that money, I devoured every piece of information that I could, from baby pips, free resources online, and I even started to pay for different groups, courses, and communities, eventually spending $10,000, which is a story for another day. But once I absorbed all this information and I demo traded for a little while, I thought that I was only a few months away from basically becoming a millionaire. So I dropped a couple $100s into a live account, and I still remember taking my very first live trade. I was living in the basement of my parents' place, a few $100s in the account. I can't remember the lot size, but I took a trade and right away I was up a few cents. I closed it and I literally made like 39 cents. And looking back, it's kind of ridiculous, but in the moment I was pretty pumped. I went upstairs, my parents asked me how did the trading go, and I said amazing. I made 39 cents and I was hooked from the very get-go. But from that point on, I basically made every possible mistake you can make. It was only downhill from here. I rather quickly lost that account. A few members of my family gave me money to trade with and I lost that money as well, which was pretty frustrating and embarrassing. So I blew multiple accounts. I would trade without a stop loss. I wasn't risk managed. I would take a trade, it would go against me, and I would reverse it, and it would go against me again, so I'd reverse it back and forth. I'm sure many of you watching have probably done the same as well. But the point that I'm making is that I made every possible mistake in the book. But in hindsight, these mistakes and these lessons and frustrations actually led to the first lesson of this video, and that is learning lessons the hard way. What's interesting about growth in trading and life, and really anything, is that day to day our lives for the most part pretty much feel the same. But it's only when you look back that you can realize, wow, my life is totally different. I'm a different person. Nothing really looks the same as it did just a year ago, 6 months ago, or a few years ago. And that's because change takes a lot of time. It's different iterations. It's a compound game, and trading is exactly like that. So for the majority of my trading journey, it was spent in frustration. I felt like I wasn't making progress. But now I can look back and remember and see how I used to trade, and I can see clearly how I'm a totally different person and a totally different trader. I'm not risk managed. I don't switch the direction of trades every 30 seconds. I'm not glued to the charts 24/7 or anxious or stressed or frustrated nearly to the same degree as I was when I first started. This lesson can only be realized though if you have patience, and the power of patience is the second lesson that I have learned throughout my trading journey, and it's really single-handedly the only reason why I have managed to secure funding of $400,000. If I wasn't patient at the very beginning or in the middle of my trading journey, then I never would have gotten to the point that I'm at now. We live in a world of instant gratification. I have a very addictive personality, and I'm not afraid to say that I am addicted to quite a few things. I am addicted to my phone. I'm addicted to these little dopamine rushes that we get, whether it's from a notification or an email or a like or comment on our videos or posts or whatever it is. I am addicted to these things, and that is just the society that we live in. Yes, there are things that I should be doing and need to do on my end to work on this addiction and this problem, but it really has a massive impact on our trading, because trading is very similar to gambling in the sense that it can give you a massive dopamine rush, not only by making money, but just the excitement and the enjoyment of being able to watch the candles fluctuate, prices fluctuate. There's a lot of colors going and moving around. That is why trading can be so attractive and so addictive. This instant gratification has some really negative repercussions when it comes to our trading, because we want that money, we want the result literally overnight. We want it by the end of the week, and if you don't have that patience, that's when the instant gratification is going to totally destroy your trading, to put it simply. Patience and instant gratification go hand in hand. So if you are struggling to remain patient, I encourage you to take a step back, take a larger bird's eye view at some of your day-to-day activities. Can you see whether or not you are addicted to instant gratification? Are you always on your phone? Are you always checking social media? I do have this issue, but this issue totally no longer applies to my trading, and I'm very, very happy to be able to say that. I'm no longer checking my trades all the time or potential setups. If I get into a trade, I'm able to look away from my screen, from my phone, whereas before I was not able to do that. So as a whole, if you want to live a healthy life, I think it's important to take as far a step back as possible from these very short-lived dopamine hits, but especially you need to 100% do it when it comes to trading. If you're using trading for gratification, it's not going to be healthy. You're going to make poor trading decisions as a result, and you're not going to find the success that you're looking for. But what's difficult is that, like most things in life, even if I'm telling you this, oftentimes we need to still experience things and live things ourselves in order to be able to actually apply the lesson. There's this idea in yoga that you need to burn through karma in order to learn lessons, and it's kind of very similar to that. As a kid growing up, if your parents tell you don't touch the stove when it's on, well, you're probably going to want to touch the stove, because you need to learn yourself what it feels like, what pain feels like, and how hot it is. And so while some of you, a minority of you watching, I hope are able to make that switch from watching this video, that's why I'm making it, to look at some of your habits to try and work through that instant gratification. Many of you watching are still going to need to make those mistakes, and that's totally fine, because I was in that category. It's easy to read an article or watch a video of somebody saying, hey, remain risk managed, but until you've blown enough accounts and lost enough money, many people just aren't able to apply those reasonable and lessons that just make sense. Ultimately, it was the combination of persistence, patience, and working through all of these lessons that had to be learned that allowed me to go from zero to $400,000. So before I discovered funding companies like Lark Funding, FTMO, my Forex funds, I was trying to grow and compound my own trading capital, which is a very tedious and difficult thing to do. But once I found out about these companies, I withdrew the money from my personal account and I used it to invest in challenge accounts. And it's because of these lessons of staying patient that I was able to pass my first 100K FTMO challenge about almost 2 years ago at this point, and that is when things totally transformed for me. The first month when I was trading that account, I received a 10% withdrawal, a 10% payout, so it was roughly $10,000, and it totally transformed my life. All of the money that I had lost over 4 years of trading, I managed to make back in a single month. And I hope that is encouraging for many of you watching. If you are losing money, just know that trading is a game of compounding. And so if you are struggling and losing money, if you stick with it, you continue refining your strategy and your execution, it's really only going to take a handful of trades to make back all of the money you've lost, and that is only possible because of funding companies. So once I passed my first $100,000 FTMO challenge, I continued to reinvest those profits into additional funding challenges, which I passed, and now I'm able to make enough money to sustain myself, to pay my bills. I live very simply. There's no Lamborghini in the background. There's no super flashy lifestyle that I post on this channel, and that is by design. By focusing on things that actually matter in life, I'm able to keep my living expenses low and have a ton of freedom that really I think a huge amount of people would kill to have. So I'm very fortunate in that sense. And of course, as I continue to make more money, sure, there's a certain level of lifestyle inflation that I think is difficult to avoid, but if you remain disciplined just like in your trading, at least I hope that I'll be able to keep things under control. The lesson here is that trading can provide you a ton of freedom. You just have to stick with it. You just have to stick with it and continue to look back, not for so long. Your life is like driving a car. You have to continue looking forward, but you do have to look in the rear view mirror at times. So when you do that, you'll be able to see the progress that you have made, and that should help you keep moving forward. Just 2 months ago, I launched my own funding company, Lark Funding, after reading countless reviews from you guys for what it is that you're looking for in a funding company. It's only a one-stage, no time limit challenge, and we're seeing a lot of traders sign up and get close to that 10% target, and it's really a life-changing amount of money that you can trade with, all the way up to $500,000. So I encourage you guys to check that out. The link is in the description down below. Thank you for watching. I'll see you in the next one, and until then, peace. How much should you risk on your FTMO challenge? This is such an important topic, but it really does not get enough attention. We all want to be that trader that passes in 1 or 2 trades, takes that nice screenshot and shares it all over social media. That's right, guys, I'm handing in my 2-week notice. I am now a full-time Forex trader. It feels so good. I know we all want to do that, but really we can only get to that point of quitting our jobs and going full-time if we pass a few challenges, we gain some consistency, and none of that is possible without the proper position sizing and the proper risk management. Do things depend on your strategy? Yes and no. If you're a scalper taking 10 trades a day, which I do not recommend, your risk is going to be much different than a swing trader who's only taking 1 trade a week. But it also doesn't depend on your strategy, because no matter how you trade, you need to be risk managed. So really, doesn't really matter. The strategy doesn't matter. You need a risk strategy. Step 1 is understanding our target. First things first, yes, 10% is a big target. If you think that you can make 10% consistently every single month, well, keep your phone close to you, because Goldman Sachs is going to be giving you a call very, very shortly, and you won't have to worry about passing any challenges, because they will be paying you the big bucks. And I mean big bucks. But yes, of course, we do have a time limit. We only have 30 days to generate 10%. So we do need to keep that in mind and make the necessary adjustments. Because of this time limit and the target that's required, we do have to risk more than we should be risking on our own personal account, or even once we get the funded account. What's important to keep in mind is that 30 days is, however, a lot longer than a lot of traders think. When you see the days dwindling down, you start to get nervous, which is totally understandable. However, 30 days is a lot longer than many of you think. If you just take out a piece of paper and you write down a few of your stats, the 10% target, you'll be surprised in how few trades you could potentially pass the challenge in. But we will get to that. And since 30 days is a lot longer than you think it is, step 2 is not going crazy. 2% to risk is just too too much in my humble opinion. 2% is too much to start out the challenge on, because if you lose just 2 trades in a row, you are almost halfway to your drawdown limit, 4%. You lose 3 in a row, you're down 6%. And I don't know about you, but when I'm in some deep drawdown, I do not think as straight. I get emotional and my trading suffers because of it, and it's so much more difficult to bring yourself out of that drawdown. Mike Tyson says that everybody has a plan until they get punched in the face. So don't be that guy who thinks, oh yeah, if I'm in a little bit of drawdown, I can handle it. And then you get into the drawdown and you start sweating. You don't want to do that. So too many traders focus on the next trade and not the allotted time period. The next trade is not so important. It's the next 10 trades that are important. So don't put too much importance on that next trade. Even though that setup is looking super juicy and you want to risk 2%, you want to risk 5%, don't do it. If it's a losing trade, you're going to regret it. So don't go crazy. Remember, 30 days is an entire month, and if you look back on all of the trades you've taken in the last month, I'm sure most of you would be surprised by just how many trades and how many setups there were in the last month. And step 3 is leveraging our gains. So this is really where the entire system comes into play. So I highly encourage you to risk 1% on your first trade. And when it comes to your first trade, you really want to start off the challenge with a winning trade. Of course, this doesn't always happen, but you have the luxury of the challenge only starting once you take your first trade. So wait for an absolutely juicy, super solid setup. I usually wait for something on the weekly that in my gut, I just know this is not something that I want to miss. And if you guys listen to your gut on that, and I think you'll probably be able to filter out a lot of potentially strong setups, but not as strong. So wait for that first setup that is just crazy strong and risk 1%. Now, this is one thing will vary from trader to trader based on your risk to reward. You might risk 1% and only make a 1%. It might be a 1-to-1. If you're more of a 1-to-3 trader, you might make 3%. But what I encourage you to do, regardless of your typical risk to reward, is risk 1% continually until you have a little bit of a buffer built up. If you make 1 or 2% on that first trade, continue to risk 1%. But once you get to that 3 or 4% mark, that's when things start to get fun. If you are up 3%, I recommend you risk 2.5%. You want to risk an amount where if it is a losing trade, you will still be in profit so you can get that free retry. But you also want to leverage your gains to allow you to hit that 10% mark in the 30-day period that you are provided. So for example, if I were to go off of a bare minimum risk reward of 1-to-1, it would take me 3 winning trades to get to 3%. At that point, I would then risk 2.5 to make 2.5, which would bring me up to 5.5%. Then I would risk 5% to make 5%, and if that is a winner, then the challenge has been completed and you are one step closer to being a funded trader. So all that to say, that is 3, 4, that is 5 trades with only a bare minimum risk to reward of 1-to-1. The smaller your risk to reward, the higher your win rate should be. So I'm sure a lot of you watching are thinking, 1-to-1, that's nothing. I have like 5-to-1. If you do, that's super great for you. That's solid. Your win rate probably isn't as high. What I'm trying to say is that even going off of just a 1-to-1, it is not unrealistic for it to potentially happen when you don't have a losing trade and you win all 5. If you do, of course, have a losing trade, which statistically is likely to happen, you would continue to risk your 1% until you build up that buffer. But all that to say, you can pass with just a bare minimum risk to reward of 1-to-1 in 5 trades. So I think that's pretty encouraging. You know, you don't need crazy stats to pass these challenges. Don't let the 10% in the 30 days be like a glaring red light that, you know, you just don't think you can work through, because you absolutely can. So that is the FTMO ultimate risk strategy. I hope that this helps you guys out. It really helped me pass my challenges. 2% is a lot to risk at the beginning. Risk 1%, stay patient, stay calm, and only take the challenge once you are consistent and confident and comfortable in your trading and your entire system. There's no need to rush it. I think most traders fail just because they're rushing the process. They're not staying patient. And at the bare minimum, you should only be taking it if you're a profitable trader. So in the worst case scenario, you'll get a free retry, and then you can just do it again and pass it the next time. So that is it for today's video. Let me know what you think in the comment section. I hope you guys are doing well. If you're still here, you have my gratitude. I'll see you in the next video, and until next time, peace. and good luck with your challenge. Peace. Forex trading offers us an unlimited earning potential, a level of freedom that only 9-to-5ers can dream of, and a method to allow us to achieve all of our goals. And yet, nobody makes money. It's why we see only a handful of traders posting flashy videos online, and often less than 5% of traders are consistently receiving payouts from funding companies. So I often ask myself, why is it that everybody fails, and is it even worth trying? Why is Forex trading so difficult? And what is it that the majority of Forex traders are doing that is destroying their chances at receiving payouts and being profitable? It took me a good 4 years of Forex trading, of taking things seriously, before I found any kind of consistency. And many times along the way, especially when I spent over $10,000 on Forex courses, I considered quitting. But of course, hindsight is 20/20, and looking back, it is now much easier for me to see what mistakes I was making that were destroying my chances of finding any kind of consistency. And now, owning my own funding company and seeing the statistics of traders, it's now clear that the mistakes that traders make that lead to deep losses is no mystery. And the thing is, they're often super easy to solve. Do you get excited whenever something new or novel comes around, whether it's trading or non-trading related? There's something called shiny object syndrome. I don't know if it's actually a real thing, but if it is, I know that I suffer from it. I get super excited and super into new things. I love starting new things, but it's continuing with those things that I personally find more challenging. And relating this to trading, it's why I think so many traders simply do not stick with a strategy, which is potentially the #1 downfall of traders. The way most strategies, if not all strategies, work is based on probability, and it's based on consistency. Most traders, after experiencing a losing streak or some consecutive losses, are quick to start looking at different Forex strategies and maybe even jumping ship and forgetting their strategy and going on to the next. And this is a problem because the probability of your strategy working out is now a 0% because you're not even sticking with it. I always come back to the analogy and the example that's given in the book Trading in the Zone. That is the importance of thinking like a casino. The casino does not care whatsoever whether it wins or loses at the next table, or whether they're profitable on that day, because they know that over time their edge is going to play out. Now, if the casino had a really bad day and lost some money, or even a bad week, if they shut down shop, of course they're going to lose money because they're not giving themselves an opportunity for their edge to play out. But of course they don't do that. They know that by the end of the year, things are going to be positive and they're going to be profitable. And so as traders, we need to think the exact same way. There's multiple levels of patience required in trading. It starts out with the learning curve, staying patient when nothing really makes sense. Then once you know what's going on, it takes patience for setups to arise, and then for those setups to actually provide you with pips and provide you with money. And it's this lack of patience that most traders have that lead them to jumping strategies and going on to the next one. There is something to be said about knowing when your strategy simply isn't effective, and it's a fine line and a fine balance between staying the course and jumping ship and trying something new. But if you are using a strategy that is well known, where you see other traders succeeding with it, then likely it is not the strategy, likely it's you, and you're simply not giving it enough time to play out. I tried a whole bunch of different strategies when I first started, and I really needed to find one that fit my personality. And once I did, I still kind of looked around for a little bit until I came to this realization. So if you've been trading for a while, if you have seen some consistency and some success with your trading strategy, just stick with it, think like a casino, and trust me, in the long run, it's going to make a huge difference. It's a marathon, not a sprint. I think the easiest thing that traders can do to improve their trading is simply practice risk management. Now, before you scroll down to the comments or look for another video because you don't want to hear about risk management, the thing is, it's boring, and that is why so many traders neglect it, but it is the single most important aspect of your trading. You can be the greatest trader in the world. If you don't have proper risk management, it doesn't matter how good you are, you're going to lose money. My Forex funds put out a statistic not that long ago, it's been just a few months, where they shared that 60% of their traders don't use a stop loss. And I just cannot even believe that. I can't wrap my head around it. If you're watching this and you're not using a stop loss, what the heck are you doing? Just use a stop loss. There's so many times when you can say, oh yeah, I'll get out in this area, and some news event, or there's just some news event comes out, or there's just huge volatility and price goes way past where your stop loss was, and you end up eating a huge loss. And secondly, you might not have the discipline to actually close it. It's easy to have ideas and have a game plan when everything is fine, but once you start to see that loss running in your account, you might not, and you likely will not be as disciplined as you are and as you were when you originally took that trade. So please just put a stop loss in place. But risk management does go beyond just having a stop loss. The most important aspect is knowing what percentage of your account to risk. Now, when I first started trading, I thought 10-15% monthly returns were super achievable. And there's many of you watching, I know, that think it is achievable as well. And I've received some mean comments in the past every time I say that it is not consistently achievable. Now, if you're willing to risk 5% a trade, absolutely, you can generate some massive, massive returns on your account. But the truth is, there's going to be a month when you experience losses, and the losses are going to be so deep that you're simply not going to be able to recover. So it's amazing to post those flashy payouts and those flashy monthly returns, but I have never seen a trader do that for 12 months or 24 months consistently, because 5% is too much, and I would even argue that 2% is too much. It's fine if you're on a small personal account and you're willing to lose all of that money, but if you're on a funded account and you are limited in terms of the drawdown that you can have, 2% is way too much. I really think 1% is the maximum that you should be risking. And the problem is, many traders don't want to dial back their risk. I totally get it. I was there for the longest time, especially when I first started trading. I thought 5% wasn't a lot. Heck, you are watching the guy that maxed out his credit card to take a trade on gold. Thank the Lord that it was a winning trade, because I would have lost several $1,000s. I was in your position. I wanted to make money as fast as possible and as much as possible, but it was through all of those losses and making all of those mistakes that I learned that it's just not possible to have those massive monthly returns while remaining risk managed and consistently in the long term. Those are the caveats that people don't like to pay attention to. The reality is, listen, if you were risk managed and generating 10, 15, 20% a month, listen, the largest banks in the world would throw money at you, and that's just not happening because you're taking a level of risk that they're not comfortable with, a level of risk that simply is not sustainable. A massive reason for why traders fail simply comes down to misconceptions of what it's like to be a trader and goals that simply are not realistic. If you had a goal of making $1,000 a day, and you're only making $10 a day, well, of course you're going to be discouraged, and that discouragement is going to potentially lead you to quitting or not putting in as much effort as you need, and therefore you're just not going to see the results that you were hoping for. I think the main culprit to blame here is social media when it comes to misconceptions in trading, whether it's scam accounts or even legitimate accounts from traders that have been trading for a long time. We've all seen those classic MT4 screenshots of traders up thousands and thousands of dollars, and we all think to ourselves, wow, it would be great if that was us. How life-changing would it be? And I'm not saying that's not achievable, but it's just not realistic when you're first starting out, because one, you need a ton of capital. Even before you secure that capital, you need to know how to trade, you need to work through your psychology, and you need to be consistent. When traders realize they're not achieving what they expected or hoped to achieve, that's what leads to less motivation, discouragement. I think discouragement is a word. I don't know, it sounds a little weird, but they're not as motivated, and that lack of motivation is not going to help them continue on in their journey. So from the very onset, whether you're a new trader or even a trader that's starting to see some consistency, at all times, regardless of where you are in your journey, you need to manage expectations. This was a huge thing for me when I received my first FTMO funded account, because I thought, that's it, I'm rich. You know, I made 10% in 30 days. I'm gonna be able to do that every single month. And I was shopping for AP watches and, you know, cars and everything, and it's not realistic. I wasn't managing my expectations. I had a misconception for what it would be like to be a funded trader. Don't get me wrong, there's still months when I make a good amount of money, and there's months when, you know, I don't make any money at all. But it's by managing those expectations that I kind of flatline my level of motivation and encouragement. There's no massive ups and downs. I really like that quote. I don't know who it's from, but it's a candle that burns twice as bright, burns half as long. And so it can be great to experience those really nice highs of motivation and encouragement, but then you're going to have those dips when things aren't working out. So, you know, having a little bit more of a flat line, a little bit more of a steady burn, I think is helpful when it comes to managing those expectations. And this goes for all traders. It'll make a massive difference in how you approach the market, because you're no longer going to be forcing trades. You're no longer going to be disappointed if you're not hitting the goal that you originally set. If you want to make money in Forex, you need to remain patient through the ups and downs. You need to stick to your strategy. For God's sake, you need to remain risk managed. And very importantly, you need to manage your expectations. 3 years ago, I paid $5,000 to take the Apex Paragon course. And that weekend in Montreal, after one of the days, I went out for a nice dinner with my uncle, and I made a bet with him that within 12 months, I would be a millionaire. It's been 3 years, if not more, since taking that course, and I hate to break it to you, but I am not a millionaire. My expectations were not realistic at all, and unrealistic expectations are only going to lead to disappointment and frustration. Fortunately, trading is a marathon and not a sprint, so remain patient, keep moving forward, and I will see you in the next video. Thanks for watching. Peace. You probably clicked on this video because you are interested in backtesting, but I am here to break your heart and tell you why backtesting is a total waste of time. In this video, however, I'm going to show you what is not a waste of time and one exercise that will totally transform your trading, guaranteed. But first off, why is backtesting an actual waste of time? I chalk it up to mental masturbation. There's YouTubers that I've been watching since I started trading, and they love to post a classic video of waking up at 5 a.m. to do 2 to 3 hours of backtesting. I've got news for you though, bud. If you are still backtesting after trading for like 5 years, you are doing something wrong, and it's clearly not benefiting you. It's clearly a waste of time. Backtesting is a waste of time because it does not take into account the execution, psychological, or fundamental aspect of trading, all three of which are the most difficult and the most important. Now, of course, if you're new to trading and learning a new strategy, of course, spend a few hours backtesting and trying things out. But if you're spending a large portion of your time doing this, you're not doing things as efficiently as you should be. What I'm about to show you, however, is not a waste of time, but it is very difficult, and only the most serious of you watching will actually implement it. Let's get into it. So as traders, it is our main job to understand what the market is doing at all times. If you want to be a scalper and a 1-minute warrior, that's totally fine. But for people that don't want to do that, and I don't recommend anybody does that, we need to understand fundamentally what's going on with the market. Now, fundamentals work in patterns. What's difficult about fundamentals in terms of teaching it is that every circumstance, every situation is different, and the market will react differently because there are so many variables. However, things do work in patterns. So it is our job to understand and to identify what the common patterns are, how each currency moves in accordance with these patterns, and therefore apply it to our trading to make as much money and as many pips as possible. So you're going to need two things. You're obviously going to need your TradingView account, and you're going to need Forex Live. If you don't use Forex Live, or if you're not familiar with it, I highly encourage you to start introducing it into your trading routine, because it is an excellent resource in terms of understanding fundamentals. The way it works is there are a variety of analysts that work during each session. So regardless of the time of day and your time zone, there will always be analysts on here telling you what's going on. So if you see a big movement happen in the market, hop over to Forex Live, and within a matter of seconds, latest a couple of minutes, there will be an announcement for what is going on. Lastly, before we get into the exercise, they have these session wraps. So at the end of each session, they compile up all of the events, so all of these, and then they write this nice little report for what is going on. So this is super helpful. You should definitely introduce this into your daily routine at the end of each session when you wake up before going to bed. Check the session wraps to see what's going on. So what we want to do is we want to identify on any pair, on any currency, whatever it is, we want to identify a big movement, and we just want to ask ourselves, why did this happen? If we can answer that question, we're very quickly, not quickly, we're going to be able to much better understand why things are moving the way they are, and this is going to help us learn about our pairs much better and trade them more efficiently. So if we start off on Euro New Zealand, we had this massive movement here that started in February 4th of 2022, February of this year. This was a move of just under 10%, and it was 1,700 pips. An amazing move that could have made you a lot of money. So the question is that we have to ask ourselves, why did this move happen? Now, we're starting off with this one because it's a very easy example. The reason why this move happened is because we had a breakout. We had the breakout between Russia and Ukraine in terms of the war. Russia invaded Ukraine, and that obviously was very, very negative for the euro, and that is why we got this drop. So the question is this fundamental landscape still in play? Yes, the war is ongoing, but in terms of pricing in the worst possible scenario, which the market did do, things are different. The war is ongoing, but we don't have fresh news of the war breaking out. So things are a little bit different. So what I would encourage you to do is to put a text box on each large movement and just put in, you know, breakout of the war. Okay, so then you can take a screenshot, come back, and you can understand why this is happening. The next thing that you would want to do is look at the next move. So this is from April 6th all the way up to the high of around May 12th. So you'd want to ask yourself, what was the fundamental component for justifying this retracement? Why did this retracement happen? Why did we bottom out here? Now, certainly we could have bottomed out because of a technical reason. Usually in accordance with technicals, there is a fundamental reason for why at this point we got this kind of move. Now, what you want to do is, obviously when there's, you know, periods of consolidation, that's a little bit trickier to backtest, but again, you'd want to look for any kind of big move. So what was happening between October 20 and February 23rd of 2021, right? This was a huge move. What was the fundamental landscape? Now, of course, you're not going to know the reason. I can't tell you right off the top of my head what was going on in October of 2020. Obviously, COVID was a big thing. Europe was pretty strongly impacted, but why would the New Zealand dollar have been stronger? Thinking now, well, the stock market was rallying. So when the stock market rallies, the New Zealand dollar, it's a risk-on currency, so therefore it's going to strengthen. So I would use that as my starting basis for explaining why this move happened. But we're going to actually get much more specific and much more concrete with this. And we're going to do so using Forex Live. So what's going to happen is we're going to scroll all the way to the bottom, okay, and then we're going to click See More. Now, as soon as you click See More, you can't see it on my screen recording, but the URL goes from forexlive.com to forexlive.com/page/2. Now, what you're going to do is, I'll try and put a screenshot so it's clear for all of you, but it's straightforward. Now it says /2 for page 2. I'm just going to put in a 0. So now it says forexlive.com/page/20. So that loads, and now what day are we at? We are now at June 30th. Okay, so do you see how we can now move back in time? What happened if we go to page 200? Put in another 0. We are now at April 26, 2022. So what you're going to do is you're going to find a significant move on your currency pair. You're going to find the date that that move started, or if you see a massive candle, for example, like, you know, some of the candles here, ask yourself, or this one's obviously a really good, this is March 10th of 2020, so we know COVID was a massive, COVID was the single reason for this move. But you're going to find the date, and then you're going to play with the numbers a little bit on Forex Live to find the actual date. So maybe we'll do an example together. Let's go to pound yen and see if we can find an interesting move. Okay, so we started to get a breakout here, going all the way back to March 7th of this year. So let's play around with this a bit. March 7th. So we need to go, let's try 250. Okay, so now we're March 13th, so we're getting quite close. So we'll do page 325. This is March 2nd. So we overshot it a bit, so we'll go 310. So it takes a little bit of playing around to get to it. Okay, so March 8th. So here we are. So we want to be thinking, okay, this is pound yen. So what was going on globally, of course, but even more specifically, what was going on with the pound? And what was going on with the Japanese yen. Okay, so March 7th, 2022. So this is what we're looking at. So we want to kind of identify this move and why did it happen. We're going all the way to the end of the month, March 29th. So the first thing that comes up is Japan Q4 GDP comes in much lower than the preliminary reading. So that is obviously going to be a weaker yen, very straightforward. So I'm just gonna throw that in. We'll start with the text box, and we will start to add up our confluences. Now, it's going to take a lot of scrolling through. You're really looking for, you know, those major headline news pieces, which quickly teaches you that you don't want to get too much in the weeds when it comes to fundamental analysis. You're looking for that big picture stuff, those strong headlines. Okay, so the governor of the RBA is saying that rates will probably rise later this year, which is funny because now we know that rates are, of course, rising. Let's see, and the session wraps are going to be what's really helpful to us. Banning Russian oil in terms of pound yen, I would think that we would have a little bit of a sell-off in the pound, or I should say a stronger yen, because that could be a risk-off move, but we did not see that. I do know, because I've been trading pound yen, that the yen specifically has been quite weak. Now we're at the 10th, okay? So China COVID cases hit the highest since early of 2020. Fail. Okay, so we know that the war is going on. Here to start, the price action was pretty minor. So the first breakout we had was actually on March 16th. So we're gonna fast forward to see what happened on March 16th. March 16th. Okay, here we are. So all signs point to an economy that can flourish with less accommodative policy. Okay, so this is a major headline right here, and this is really going to be a strong component for why we saw this rise in the yen. The reason for this is a very good sign for global economies, and because it's a good sign for the global economy, it means that there's not going to be as many investors, institutions, banks that are flooding into the yen, because the yen is really used during times of uncertainty. So we're going to add that to our list. Here can accommodate higher rates. Okay, so that's going to be a big impact there. So we're already starting to put the pieces together, okay? We see they're going to start to reduce the balance sheet, so Fed reducing balance sheet. Now I hope you guys are putting the pieces together of how, you know, everything is connected. So even though this is only pound yen, the US news is having a strong impact on what's happening, because the yen especially is traded as a global asset in terms of risk sentiment, or in connection to risk sentiment. Okay, so that's good. So the interest rate decision, so raises the target rate by 25 basis points. Okay, so they also raised rates. Pretty much, you could continue to go into this, and I encourage you to go into it, but this is giving you a good idea for what was going on at the time globally and why we would see a rise in pound yen. So you maybe want to do a little bit more research specifically for what was going on with the pound, if there was anything that was justifying a stronger pound, or if this was solely a play on the yen, on a weaker yen. But this is really good. This is giving us a really good outline for what was happening in the world. So now that you understand this, you take a screenshot, you can save it. A lot of questions for you are going to arise, and you're going to want to do research to answer those questions. But now, right off the bat, we can tell and we can see, okay, when the Federal Reserve starts to reduce their balance sheet, when they start to raise interest rates, it's a good sign for the global economy because things are doing well. What happens to the stock market is a totally different situation because stocks obviously sold off. But you can see here that we don't get that flight to safety in currencies right off the bat. Now, this is for the yen. The dollar is a different story. The dollar is much stronger because remember, you sell stocks, you exchange them for US dollars. So there's so many moving pieces and so many variables, and that can be what makes fundamentals difficult. But you can see here that the yen specifically, we had a fundamental reason for Japan struggling. Japan is in a little bit of a precarious situation fundamentally right now. So weak GDP, lower than expected, slower economic growth than expected, and therefore a weaker yen. People aren't going to want to park their money into the yen. So boom, that's reason number one. Reason number two is, you know, things are starting to look good. The global economy is recovering. Higher interest rates are on the way. So we're going to see less of a shift or less of a movement towards the Japanese yen. Again, you'd want to do a little bit more research on the pound, but this gives you a really good example for what was going on. So now you would use this knowledge that you have and this tool to better anticipate the moves that are going to happen. So next time you see a headline of saying this country, their GDP came in much lower than expected, what are you going to do? Are you going to buy that currency or are you going to short that currency? Of course, you're going to want to short it. You're not going to want to buy it. Again, you would pair it with your technicals. We're not just going to be purely fundamental traders, but combining these two tools will totally transform your trading. If you do this enough times, and it takes time, it takes practice, you're going to be able to much better anticipate the moves that are forthcoming and why the market moves the way it does. This is going to help your Forex trading, but it will also help you understand what's going on in the world, and especially those of you that are investing in the stock market. Hopefully all of you watching are investing in the stock market and not just blowing your FTMO payouts. But this is a tool and an exercise that I did quite a bit when I first started trading, and it really helped me so much with my fundamentals. I know it's a topic that a lot of you kind of struggle with or want to learn more about, and this is literally the best way that I know of to test it out. Perhaps some of you know a better resource than Forex Live of going back in time. If you do, drop that in the comments down below. It'll help other people out. I will check it out myself. But this is the exercise you want to be doing, not back testing technicals. You can do that for a couple hours if you're starting out, but this is what's going to transform your trading and your knowledge base, and you will be a much better trader because of it. If you made it this far, I appreciate it. Drop any questions you have down below. I will get to them. I'll see you in the next one, and until then, peace. So much focus goes towards passing the FTMO challenge, but really only about 5 to 10% of traders actually accomplish that goal. Now, yes, it's not a great number, but the goal of this channel is to help as many of you as possible actually pass the challenge. Link is in the bio to my new course. But I don't want to neglect those of you that have passed or are very close to passing the challenge. Many think that once you get funded, it's smooth sailing all the way to those payouts.
Because it's awesome.
But the reality is, there's actually a new kind of stress that comes with being a funded trader, and it can still come with some rocky waters. I got my first FTMO account 13 months ago, and I haven't quite yet blown it. So today we're going to be talking about 5 questions and mistakes that traders face once they get that funded account. Once you are funded, how much should you risk on your account? How much should you risk on each trade? This is probably the most important topic, and one of the most important changes that I think traders need to make once they receive that funded account. Now, during your challenge, you were most likely risking at least 1%. I always recommend traders increase their risk as the profit on their account grows. So at some point, you might have been risking 3% or 4%. But when it comes to a funded account, I really think that if you want to make a ton of money, like most of us do, you need to focus on capital rather than risk. What I mean by that is instead of risking 2% or more on your funded account,
Risk disclosure.
you should continue to do challenges to grow your capital, so a 1% risk or less will actually provide you with a ton of cash. The thing is, many of us think that 1% is a very reasonable amount to risk, but the thing that is important to keep in mind is what happens if you experience a few consecutive losses. What happens if you have 3 losses in a row and you risk 1% each trade? Your account will now be in the negative by 3%. Now that is okay, but what tends to happen to a lot of traders, including myself, is there's a new level of stress that comes on once that funded account is in drawdown. You worked so hard to get it, you paid money for it, and you want to make money from it. And so many traders, when they experience drawdown, they start to do silly things. They mix up their strategy, they do things differently, and then it just spirals, and before you know it, they are in such heavy drawdown that it's almost impossible to bring that account back up to its initial balance. So that is why I think risking 1% on a funded account is too much. There's a reason why when you receive your FTMO funded account, they send you an email saying, well done on passing, you have clearly proven yourself to be a good trader, but don't get overly excited because they see many traders fail as soon as they get that funded account. They see many traders blow that account. So all that to say, my recommendation here is once you get that funded account to only risk 0.5%. I think 0.5% is such a nice sweet spot because it's less than that that 1% where after just a few trades, you're going to be into deep drawdown, and it's enough for you to still make a really nice amount of money each and every month. Even if you only stick with that $100,000 account, if you risk 0.5% and you make 2% in a month, which is not overly optimistic by any means, 2% a month is going to earn you $2,000, which is still a really nice sum of money. Certainly you're not going out to buy Lambos with that kind of money, but if you continue with that percentage return, you can continue to pass more FTMO challenges, and before you know it, that 2% return every single month on a $400,000 FTMO account is $8,000, and then you're getting pretty close to Lambo money. I encourage you to experiment with the percentage of risk that you use on each trade. Depends on your risk management style, your risk reward. There's a lot of different factors, but for the most part, I'm pretty eager on 1% being just slightly too much risk when your account is at its initial balance. Lower that down to 0.5%. It's going to help with your stress, your psychology, and overall, I think it's just going to help you be a more profitable and consistent trader. Should you leave a buffer in your trading account? I get to ask this question all the time, and the simple answer is no, absolutely not. Do not leave a buffer in your account. Now, this might be a slightly unpopular opinion to some traders, but the reality is, if you are getting to the point where you can actually receive a payout, you are in almost the 1%. But all of that to say, you are in an incredible minority if you are actually in an opportunity to take out money from your trading account. And in my opinion, it is just silly to leave that money in because you're afraid of hitting some drawdown. The reality is you might actually hit some drawdown, but why would you want to lose money that you are entitled to? Not only did you have to pass phase 1, you had to pass phase 2, and long before taking the challenge, you had to learn to trade. You probably invested money in a course, in learning, and you really should repay yourself and receive back that investment cost when you have an opportunity to do so. Potentially, psychologically, having a little bit of a buffer might help you with the stress. If you are somebody that's going to be stressed by not having a buffer, I just highly encourage you to kind of work that out, maybe lower your risk. The whole point of trading is to make money, and if you have made money, well then pay yourself. It was probably a long journey to get to that point, so I really don't think leaving a buffer is the way to go. Take out your money, enjoy it, invest it, continue to grow it, do what you want with it, but just make sure it hits your bank account. How much profit should you aim for every month? Many traders, after making that 10% in 30 days and 5% in 60 days, think that they can hit those targets every single month on their funded account, and I'm not so sure that's a realistic or reasonable goal to have. The first month that I had my funded account, I did indeed make 10%, but I continued to risk 1% a trade. So that payout was fantastic. I thought I was only a few months away from buying a Lambo. But the months that followed that payout were much slower, the market wasn't moving as much, and I only generated between 1 and 4%. A few months after that, the market changed again, and my account actually experienced some drawdown. That's when I realized that a 1% risk per trade was a little bit too much for me. When it comes to goal setting, I'm really adamant on you focusing on inputs rather than outputs. And so I'm not a huge fan of having a percentage return goal every single month. For the longest time, ever since I started trading, I always had a goal for how much I wanted to make every single month, but it's really outside of our control because we can't control how many setups the market is going to give us. We can't determine or control how much the market is going to move. So I'm much more adamant on you focusing on things that are within your control. So instead of setting a percentage return goal every single month, I would maybe set a goal for how you want to execute your trades. One goal that I currently have is to take every single setup where there are 3 confluences or more on the daily. If I do that, I know that over time, by the end of the year, I will be a profitable trader, I will receive those payouts, and things will be good. If you set a monthly percentage return goal and you don't hit it, you might think that you're doing something wrong and you'll mix up your strategy and your system, but it might not be you at all. It might just be the market conditions. So really be careful with how you're setting goals and do your best to stick to things that are within your control. Can you expect a payout from FTMO or my Forex funds or whatever funding company you're with every single month? The answer is no. You're not going to have a payout every single month. Now, there will be some traders out there that do experience payouts every single month. When I first got funded about 13 months ago, I think I went 4 or 5 months consecutively of receiving a payout. And then I had a couple of months of drawdown. It's totally normal, it's totally natural, but it's something that's really important to keep in mind, because if you do end up quitting your job to trade full time, you need to do so with realistic expectations. You can't think that because you had 1 or 2 good months that it's going to be like that every single month. It's not going to be like that. There will be times when the market is quiet, like now, and there will be times when you have tons of setups. But I think it's unrealistic to expect a payout every single month. I'm currently getting my real estate license here in Montreal. I'm almost done the year-long program. And one thing that I have learned is that when you're a real estate agent, you have no idea when your next paycheck is coming. It's very, very similar to trading in that regard. And so you need to really manage your expectations and manage your budget accordingly. So if your goal is to go full-time, I have a couple of videos talking about trading full-time. And one of the most important steps is to have a buffer of at least 6 months of living expenses saved up. You don't know when that next paycheck is going to come. So if you are funded, do not get discouraged if you have a month or 2 where you are not profitable. It happens to the best traders, and all you really need to do is make sure that your goals and expectations are realistic and achievable. What do you do and what happens if your FTMO account starts getting into some drawdown? Now, most traders, when we experience a few wins in a row, we're flying high, we think that we know exactly what the market is going to do, and we never think about drawdown. But the reality is, all of us at some point are going to experience drawdown, and it can be extra stressful when it's on your funded account because you work so hard for it, and obviously you don't want to lose it. The most drawdown that I've experienced on my FTMO account is about 3%, and I have to admit it was pretty stressful, but it did teach me some really important things about trading and psychology. The reason most traders aren't profitable is because they don't stick with their strategy long enough, and they don't approach trading like a casino. Casino understands that it does not matter what happens at the next blackjack table or the one after. It doesn't matter what happens this week or the next week. The casino understands that their edge will play out over a large enough sample size, and as traders, we have to understand this as well. Our strategy works on a statistical probability. We cannot determine or decide what trades are winners and what trades are losers, and it's because of that that when you do experience drawdown, it is imperative. It is super, super important that you do not change anything. You have to stick with the plan, stick with the strategy, and just continue doing what you were doing, because over time your edge will play out and you'll bring that account back up into profit. If you, however, determine that your losing streak and drawdown is a result of your strategy and system, and you start mixing things up and changing things, that's when I think things can get ugly and you could actually lose your account. So I highly, highly recommend that you stick to what you were doing. If you pass the FTMO challenge or my Forex Funds challenge, you know how to trade. So there is no reason to mix up your strategy. Many of you watching this might be going through a period of consecutive wins, and so you might think that you are bulletproof. So I highly recommend that you come back and watch this video, revisit this lesson when you are experiencing drawdown, because there's a good chance that it's not actually your fault. It's just the odds and the statistics playing out. You have to stick with it in order to bring that account back up into profit. Now, if you are not yet funded, there are a ton of funding companies out there. Some of them are doing some really exciting things. So check out this video, which is now one of my favorite funding companies, and I compare them to FTMO with only a 1-stage evaluation, so it might actually really help you get funded that much faster. Albert Einstein said that the definition of insanity is doing the same thing over and over again and expecting a different result. Since I've started this YouTube channel, I have received dozens of DMs, and in the last 2 months, I've been working on my mentorship program, and it has become clear to me that a lot of traders are failing their FTMO challenge for 3 very specific reasons. And all of these reasons would fall very neatly under Einstein's definition of insanity. So in today's video, we're going to be going over the 3 reasons why most people are failing their FTMO challenge, what you can do from it, and how you can pass yours. Let's get into it. Hi guys, welcome back to another video. If you're new here, my name is Matt L. I'm a full-time Forex trader living in Montreal, and I'm also getting my real estate license on the side. 70% of you guys watching this are not subscribed, so if you get value from it, please hit that subscribe button. It really helps my channel grow. The first reason why most traders are failing their FTMO challenge, it's just because their risk management absolutely sucks. Now, I know it might sound harsh, but statistically, you are most likely to fall under the category of traders that are simply not remaining risk managed. Now, there's a few different things that you could be doing. You could be simply just over risking. You could be inconsistent with your risk. You could just be totally all over the place. But not having a clear and well-defined risk management system is really going to be detrimental to not only your success in trying to pass the FTMO challenge, but in your success overall in trying to be a trader. Risk management is probably the most boring aspect of trading, but it is by far the most important aspect of your trading. I see so many screenshots posted online of traders passing their challenge in just 1 or 2 trades, and it's super impressive, but we need to keep in mind that for the number of traders that are posting these types of screenshots, there is at least 10 times more traders that tried to do it but failed. They paid for a 100k or 200k challenge, they dished out like $1,000, and in just a day or two they totally and completely lost it. That's how these funding companies are making so much money. So you really don't want to fall into this category. You want to be in the 10% or 1% of traders that are making money, and in order to do so you need to remain risk managed. So the teaching that I would like to pass on to you guys and encourage you to seriously think about is what you define as risk managed. When I first started out trading, I would risk 5% a trade, and to me I thought this was totally normal. At one point I maxed out my credit card because I was so convinced that a trade was going to work, and I just put it all on black. Fortunately, in that situation it worked out for me, but there are just as many other times when I risked too much and I lost it all. 5% is definitely too much, and if you think that 2% is a reasonable amount, I would really encourage you to reconsider that and ask yourself if there's any emotion involved in that decision. If you think about it, 2%, it only requires 2, 3, 4 trades until you're in some serious drawdown, and it's easy to say you can deal with that now, but when your account is down 6, 8, 10%, I haven't seen a lot of traders that are able to remain emotionally stable and follow through with their trading plan and not make rash decisions that will only deepen their drawdown. 2% for me, all of that to say, is too much. I highly recommend you risk 1% per trade, and even then at times I will risk much less than 1%. I will risk 0.5% on a trade. That is my pretty standard risk profile nowadays, and I highly recommend that you do it as well. This will give you a lot more breathing room and a lot less stress in your life when it comes time to dealing with losing trades, which we all need to deal with at some point or another. Remember, the key to making a lot of money in this game is not going to be so much growing your small $1,000 account to $100 million. Really, what we want to do, now that we have access to these great funding companies, we want to have as much capital at our disposal so we can remain very tightly risk managed and still make a lot of money. If you're generating 3, 4, or 5% a month on a 400k account, well, for most of you watching, I'm sure that more than covers your monthly expenses. So keep that in mind, remain risk managed, and I think you'll be able to pass your challenge that much easier. The second reason why I see so many traders failing their challenges is simply because they don't have a strategy. They'll do something one day, they'll do something completely different the next day, and there's no consistency and no clear outline for their strategy. Now you might be watching this and think, well, this is stupid, I have a strategy, but really you would be amazed how many people send me screenshots of their trades and ask what I think, and I ask them, well, why did you take this? Why did you draw this? And they have absolutely no idea why they did it. Now I can understand there are a lot of resources online and it can get pretty confusing pretty quick. As always, if you read enough and consume enough, everything cancels itself out. So you really need to be selective in the type of strategy that you develop and the type of content and knowledge that you consume. But what I want to encourage you to do is to really get absolutely clear cut and have a brutally clear understanding of what your strategy is. When I first started trading, people often recommended to me that I write up a trading plan, and I thought that was the stupidest thing in the world. I know in my head what my strategy is. I don't need to put pen to paper, and it's only in the last few months that I did it, and it's actually made a very clear difference. If I make a trading mistake that goes outside of my trading plan, well, I can look at the document that I wrote up, understand that it was outside of my rules, and I have nobody to blame but myself. I will be putting a link down in the description below to give you guys free access to my trading plan. You don't have to use it, but it could give you a good framework for how you might want to draft up yours. All of that to say, if you're taking the FTMO challenge before you have a clear strategy, before you know exactly all of the rules that are going to be involved with your entire trading system, I highly recommend that you don't take the challenge just yet. You invest time and perhaps a little bit of money in learning how to properly trade. It will make all the difference. There is no rush, but you do need to take it step by step. The third and final reason for why I see so many traders failing their FTMO challenge is because they are inconsistent. They're inconsistent on multiple levels. They're inconsistent with their trading overall, but they're also inconsistent with their decision making, with their thought process, with how they execute their trades, manage their trades, just everything that is involved in the entire trading process, from formulating a trading idea to executing it. Everything is inconsistent. This might not seem like the biggest deal, but I think it is one of the most underlooked aspects of trading that is really detrimental to your success. For me, I have found that as I've gotten more experience with trading, the more I can systemize the entire process, the better I become. Just this week, I had a pending that I set before going to bed, and I was lying in bed and I was about to cancel it because, you know, I just wasn't so sure about it. I had a little bit of a gut feeling that perhaps it wasn't going to work, but I asked myself, does this stick and is this in line with my trading plan? And it was. As a result, I woke up, the pending was hit, and I hit full TP by the time I woke up. And the lesson here is that you don't want to rely on your emotions. If you're anything like me, you can wake up feeling one way one day and totally different the next day, and that is not good for trading. We don't want to rely on our emotions. I think we could get to a place down the road with enough experience when our gut feeling could really, you know, be a good indication for how we might want to approach things. But at the beginning, I think it's really, really important and really more valuable to try and systemize everything and take as much emotion out of your trading as possible. So all of that to say, what I recommend you do is look at every single aspect of your trading and bring it down to a system. Write up a system. Formulate some kind of system and method that you can replicate day in and day out. It's going to make your trading not only easier, but much more effective, much more efficient, and much more consistent. And that is it for the 3 reasons why I see so many traders failing their FTMO challenge. If any of these resonated with you, and if you could see yourself in any of these 3 scenarios, don't worry, it happens to the best of us, but I would really encourage you to try and work on things before taking another challenge. As a quick overview, number 1, your risk management sucks. Don't risk too much. 30 days is way longer than you think to generate 10%. If you properly leverage the gains you have already made during the challenge, you can easily pass while remaining risk managed within just a few trades. No rush, remain risk managed. It's key. Number 2, you don't have a system, you don't have a strategy. You need to know absolutely crystal clear what your trading strategy is before you take a challenge. And lastly, you're inconsistent. You're inconsistent with your actions, your thought process, your routine. Everything is just inconsistent. You're leaving it up to emotion. And I highly, highly encourage you to formulate a system that goes beyond just your trading strategy, so you take as much emotion out of the entire process as possible. That is it for today's video. If you guys got value from it, please hit that subscribe button. If you have any questions, let me know in the comment section down below. If you're still here, as always, you have my gratitude. I'll see you in the next video, and until then, peace. I first got funded back in March of 2021, which means I have been trading a funded account for roughly 18 months. Along the way, I have received multiple payouts. I have had my fair share of break-even months, as well as months where I actually ended in the negative. Through the ups and downs, however, I have managed to maintain my funded account, remaining in the slim minority of traders that do so. So no, I haven't yet managed to buy a Rolex or a Lamborghini, but I have managed to keep the day job away.
Thank God. I can't go back to folding pants at the Gap.
When you first receive your FTMO funded account, they send you an email congratulating you, but they also send you an email warning you that it's at this point that many traders get overly confident, do things that are outside of their trading plan, and quickly lead to blowing their account. I don't want you to make this mistake because a wise man once said, learn from the mistakes of others. I don't know who said that, but I'm sure at some point somebody did say that. I want to talk about stress because many traders say that part of the reason that they fail their FTMO challenge comes down to stress. So if you manage to get over that stress and pass, what's the stress level like when you receive that funded account? For the most part, in my experience, pretty much all of the stress dissipated once you receive that first payout. Because once you receive that first payout, you kind of prove to yourself that you can actually do it, and you also get refunded the challenge fee. So it's at that point that you are essentially totally risk-free. You have no more risk on the table, which is nice. There is still a level of stress that you experience, however, and it's a different kind of stress than you experience when you take the challenge. Taking the challenge, you obviously don't want to fail because you don't want to lose your deposit on that challenge, but there's also a certain level of stress in terms of wanting to prove to yourself that you can actually do it. As traders, we can sometimes just not know if we can actually do things. That didn't make any sense. Yeah. It can be stressful taking the challenge because we don't know if we're going to be able to pass. Is the market going to give us enough setups? How is our trading style and strategy going to match the criteria that FTMO outlines? The kind of stress that you experience with a funded account is one of not wanting to lose the account and not wanting to lose any profits that you have generated. So of course the first one's straightforward. You work really hard to get that funded account, you're stressed because you don't want to lose it. Totally understandable. The other one is a little bit different because the gains that you make are only paper gains, so you're really only entitled to them if you still have them in your account at the end of the month. But once they're kind of in the account, in your trading account, you kind of still think you're somewhat entitled to them. And so if you're up, say 5%, you're up $5,000 and you have a few losing trades, in your mind, at least for me, I was like, oh man, I lost $5,000. I envision my life with that $5,000 in my bank account. And that can lead to stress and frustration and anger. Certainly anger on my part. I have anger issues. So like most things in life, and certainly all things with trading, it's a game of iterations. You're going to continually improve and need to improve over time. The level of stress is different, but I would say overall, once you receive that first payout, overall the stress is much less than what you'd experience during your FTMO challenge. The beauty of having a funded account is that it allows you to trade way less and yet still make way more money, which requires a transition in the mindset of traders. Like most things in life, we think that the larger our output, or the larger the input, the larger the output. In other words, the harder we work, the larger the result we think we're going to get. And I think the thing that makes trading potentially the most difficult is that this law or this idea doesn't apply. If you spend your entire day staring at the chart, you're likely not going to make any more money. Certainly when you're first learning, you need to put in the initial investment of time to learn, to gain an understanding of what your strategy and system is going to be. That's all fine and dandy, but you're quickly going to reach a point where more time input, just overall more input, is going to be detrimental to your trading. And this might not sound like a big deal, but it's actually massive, especially once you have a funded account, because all of a sudden you're going to be able to make what is probably a month's salary for many people in a single trade. And that is going to have a psychological impact. For some of us, if we tend to like self-sabotage, I don't even know if I fully believe in that, but if we do self-sabotage, it can be weird seeing these numbers in your account if you're not used to them. It might take an adjustment period, but the main point that I'm trying to make here is that you can make way more money by doing less. This is how it should be. You shouldn't be spending your entire day on the charts, and this is going to create a massive amount of freedom in your life, which is fantastic, but really requires a sense of discipline and kind of a sense of urgency to fill it. Now, I don't think you should just fill these holes, you know, willy-nilly. You kind of want to construct your life in a way where it's meaningful. I am no pro at this. This is something that I have struggled with the most out of all aspects of trading, especially when it comes to full-time trading. I've really struggled with this, of finding things to do, projects, passions, setting new goals outside of trading, now that I spend like 30 minutes a day trading and being on the charts. I often get asked whether or not I think that traders should continue to trade personal capital or if they should just focus on their funded capital, and I am really adamant on only trading a funded capital. Unless you're a hedge fund baby and you have tons of money to just dump into your trading account, you're likely not going to have an amount of money that you can trade with that's going to be life-changing. Certainly you could have the goal of compounding that account and of growing it, and that's totally fine, but I am of the mindset that why would you risk your own capital, your own money, when you can be risking somebody else's? Let's say you have a $10,000 account. The number of challenges that you can take with that $10,000, you can obtain way more funding and therefore make way more money by investing that $10,000 into different challenges and trading those funded accounts. If you go with Mint Funding's $1 million or $2 million account, that's however much money, and with that leverage you can be making a ton of money. I recommend you actually go with Lark Funding. We've got $1 million challenge coming soon, but you know, link in the description down below. But I think this is overall a much better approach than trading your own capital. Even if you take your profit splits and say, okay, I'm going to take my profit splits and put that into my own personal trading account, I don't think that's necessarily the best approach. If anything, just continue taking challenges, continue growing that capital. Statistically, you know, trading is super difficult. You're in the very slim minority if you're receiving those payouts. So I would take that money and I would invest it outside of trading. You need to kind of diversify where your funds are going and where they're, by extension, eventually going to come from. I take my profit splits and I put a large majority of them into stocks. I invest in myself through courses and through different things, and then different businesses as well I also invest in. But I have never, since being funded with the FTMO, taken a profit split and put that into my own personal trading account. I don't even have my own account anymore. When you really break everything down and combine all the new elements that come with being a funded trader, ultimately it comes down to a very fine balancing act between wanting to keep your account and wanting to make money. Are you gonna play defense or are you going to play offense? I don't think just one is the right answer, but I think finding a balance between both is going to be the key to long-term success. At least that's what's worked for me. I think this is when goal setting can really come in handy. What is your goal with this funded account? Is it to receive consistent payouts, or is it to kind of hold on to it and just really aim for a huge home run? There's not a right or wrong answer, and of course you could aim for both if you have multiple accounts, which I think is a fantastic thing to do. You could have one funded account where you go for those consistent payouts every single month, a lower risk account, and then you could have one where you kind of treat it like a challenge, where you can increase your risk over time as the account grows and really try and receive a huge payout. Some traders default to offense and want to over risk and just receive that huge payout, and some traders kind of automatically go to defense. I would say I'm slightly more prone to going to defense. If I'm up 5% in a month, I kind of stop trading because I want to just receive that payout. And yes, you know, statistically I might be losing out on larger payouts, but I think there's also months when I have actually saved money by kind of playing it safe once I'm up and just making sure I lock in those gains. No matter what way you put it though, having a funded account can absolutely be life-changing, and I receive messages every day from traders that have either gotten funded, are close to, or are just getting started. And if you're one of those traders, I highly encourage you to stick with it. My rent is $900 a month. I need to make less than $1 I have 200K account, so I need to make 0.5% on my $200,000 account to pay my rent, which I think all of us watching think we can do on a consistent basis. If you can get that funded account and if you can just approach it with the right mindset, it 100% can change your life. Just a few years ago, I was working a regular retail job and I absolutely hated it. I spent the entire day talking with coworkers, actually just bothering coworkers, but talking to them about how we could get out of this job. I don't take my life or my job, if you can even consider this a job, for granted. If you made it this far, you have my gratitude. Stick with it. I'll see you in the next one, guys. Peace.